I think the markets have been mispricing the Fed for a while now.
We don't think the Fed is done.
How high does the Fed need go? It needn't go too high, in part because of the confidence it's instilling in investors and the public.
Effectively, I think what we're seeing is that things are actually improving around the world.
Maybe nothing happens and we just have a plain run-of-the-mill recession. That's my bet at this point, if we have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Gentlemen, a really important programming notice. 8:30 Eastern Time, inflation. Milan Spurs a little bit later. Don't forget, get it in the diary.
How about the acquisition of the Roses? At what time is that?
Yeah, that's not happening.
Yeah, well, that's like, Fort Knox, you're wearing a
There's
bar
a card
gold
left on the side, and
then that's it.
And then that individual goes away on a work trip. So the Roses are on sale when they're back. That's good. From New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. A happy Valentine's Day to you all. Equity futures positive 0.2%. Looking ahead to that inflation data. TK, CPI, just around the corner.
Really, really important, and I think some of the coverage has been off the mark. I really want to make this clear, and I'm going to go to David Rosenberg, who was iconic at Merrill Lynch before running his own shop up in Toronto. Rosenberg used to put down page 3 or page 4 of his must-read all the partitions of CPI, all the individual things. They summed the numbers we're going to talk about at 8:30. But the adults, Steve Stanley of Santander with us at 8:30 before Ken Rogoff, they're going to look at those partitions to try to figure out the vector of the top line number.
Got to talk about a price action coming into today as well. So last week was the worst week of the year on the S&P 500. Then in one single session, Lisa, we took it all back.
This is really the issue, is that people want to buy. There is a melt-up kind of feel. And even the Bank of America Fund Manager survey that just came out shows that, yes, people are more neutral or less overweight on stocks, but still are more overweight than they are historically. So basically, a lot of people still buy what this market is selling.
I don't know what to make of it. To me, there's some real negative sentiment out there, and I see it in some of the tea leaves, but you're right. In others, there seems to be not a froth, but not a toxic brew, not a froth, just there's just an oomph of optimism.
There's a new most crowded trade over at BofA. If you read Michael Hartnett's note from this morning, it's no longer the US dollar. It's been replaced by long Chinese stocks and long investment grade credit. They're the two most crowded trades right now.
The strategist we had from Voya the other day, Barbara Redfield, was phenomenal on this. Everybody's on board the international play.
We'll pick up on that story, Tom, a little bit later. Let's pick up on the price action now.
Please.
Equities up 0.25% on the S&P 500. No real drama. A lift yesterday. As I say, a lift of more than 1%, wiping out the losses of last week. Yields come in about a basis point on a 10-year, 368.64. Yesterday on a 2-year, 4.55. The new high of the year since the morning of payrolls Friday. A couple of Fridays ago, Tom, we've had a 40 basis point plus move on a US 2-year.
Look at this, and 82 basis points. Priya Misra wrote this yesterday, negative 82 basis points on that vanilla spread. It grinds, but nevertheless, we get a larger inversion, and I'm hearing from people who've been right on that we have further to go.
Lisa, a real turnaround in the bond market over the last couple of weeks.
Indeed, and let's see if we build on that after 8:30 a.m. when we do get US CPI for the month of January. As we were talking about, Tom really was laying this out. The underlying components are going to be incredibly important to dissect. We are expecting a month-over-month 0.5% increase, and the month-over-month is going to be more important perhaps than the year-over-year, which does show a decline simply because of some of the base effects and some of the compositional changes. What I'm looking for is when you strip out goods, when you strip out shelter, what do you see? Do you see services side inflation really picking up? Also curious about that used car price aspect. I know I keep talking about this, but car prices are reaccelerating, how that features in. Today, we then get the response from a host of Fed speakers, including Fed President Tom Barkin, who is joining you, John, at 9:30 a.m. on Bloomberg Television. I'm very curious to hear how you tease out what the reaction function is. It's going to be a fantastic discussion. I recommend everyone watch it, as I will. Dallas Fed President Lori Logan is speaking at 11, Patrick Harker of the Philly Fed at 1 p.m., and New York Fed President John Williams at 2 p.m. Is there a growing consensus of 225 basis point rate hikes, which seems to be baked into the market at this point? And at 1:15, the view from President Biden. He is speaking in Washington. He's going to be discussing the CHIPS Act. He's going to be discussing the Inflation Reduction Act and more. With respect to the IRA, especially in light of some of the Ford news and others, how does he give a nod to his European allies? How does he give a nod to this idea that it is drawing competition and drawing business to the U.S. at the expense potentially of Europe, John? And I do think that's going to become a growing tension throughout the year.
Lisa, can we deal with the and more piece of what you just suggested? Do we get a Brainerd announcement a
Well,
little bit later?
Right. So the Brainerd announcement is probably a given. And if you really want to go there, the and more could also be potentially a nod at a 2024 run, right? Because a lot of this is sort of the greatest hits of his administration.
And Bramo, thank you. Lisa, on the latest, the day ahead, did you see that? The latest reporting from the team down in Washington, Tom. The Fed vice chair may be announced as the economic advisor, top economic advisor to the president.
Josh Wingrove did an all-nighter on this, and I guess it's poised. And I don't know why are they teasing this out? I mean, I don't understand what the White House is thinking on this. It's not a big deal. She's been there before. She's coming over from Fed, replacement of the Fed. Everybody's talked about it's going to be big shoes to fill. But I just don't get why this is drama. Just announce it.
I don't think it's drama either. The timing's interesting, though, Tom.
Yeah,
the day of inflation.
Yes.
The day of inflation.
I will go back to one theory, not my theory, that they're lining her up to replace Chair Yellen at an appropriate point.
Perhaps they're trying to line someone up to replace her at the Fed. And exactly to that point, the fact that CPI is coming out, maybe that's the holdup. Possibly.
We'll talk about it a little bit later. We'll head down to Washington in about 10 minutes' time. Futures are up by a third of 1%. We've had a big move higher in bond yields over the last couple of weeks. Christian Nolting has a big call. Global CIO at Deutsche Bank Private Bank. Christian joins us right now. Christian, I'm not going to bury the lead. 420 on a US 10-year is what you and the team are looking for. What gets us there?
So this is for the end of this year, and I think first growth would come down, but I think looking towards the end of the year, as we don't forecast a massive recession, if at all, I think then we look into 2024, and there's some growth in the US, and that's why 50 basis points higher than now, I think, is absolutely possible from our point of view.
If you have a mandate to be in the market, given that move in yields, higher yields, lower prices, the effect, the linkage to inflation, the effect on equities, how do you participate in the stock market given higher rates and in more durable inflation?
So we agree with that view that inflation is more durable, especially what Lisa was just saying, right? So if you look at the core inflation, if you take out food, energy, if you look at services, we think that's going to be sticky and stay higher. And from that perspective, we look at those companies who are price makers instead of price takers. And if you look at the earnings season right now, you are seeing this already, that they do better. And I think that could stay throughout the year.
If active management is more conducive here, and we're hearing that from a lot of people, including all of the Deutsche Bank Combine, what factors help you choose which stocks to pick?
So it's as always bottom up, top down. So top down, of course, from a macro perspective, which sectors do we like in that environment? Which sectors do bode well in that kind of environment? And then bottom up, you look at the single companies, which I said, where you have probably rather those who can deal with high inflation better, who are able to do potentially some cost cutting. I think that's the areas where we want to go.
We were just hearing from John as he laid out the recent fund manager survey from Bank of America that investment grade credit is one of the most crowded trades or the most crowded trade. How does your call on 10-year treasuries affect that? Would you lean heavily against that because of the duration component?
Yeah, look, at duration, of course, is relatively high. I agree with that. But I think if you look out in duration, so if you look out of the curve, we don't see massive change there. So, of course, short end will still be inverted from that perspective. I think we have seen quite a rally in spreads. I mean, especially on the high yield side, but also on the investment grade. And I think over the next months, I wouldn't be having this call as well, because we go for lower growth. We will have the discussion, is there a recession or not? From my point of view, that could be a little bit higher spreads. Towards the end of the year, again, that could look differently. But I do expect some volatility in spreads over the next months.
Do you see the same disconnect that we've been hearing about from Morgan Stanley and others between bonds and stocks, with bonds pricing in much more aggressive central bank reaction and stocks basically looking past that and continuing the same playbook of the past 10 years?
Yeah, you talked about flows. I think that's important. So if you look at flows, we've been seeing in that stock market rally, the flows have not been, let's say, very supportive of that. I think we have seen kind of a squeeze to a certain extent. From that perspective, I would rather be with the bond side at this point in time and maybe taking some gains in the stock market here. Of course, there is still this fear of missing out. FOMO, yes. But I think if you look what we have achieved so far in performance, I think 6 weeks, which very nice performance. You cannot just say the whole year would be like this. If so, fine. But I think we shouldn't plan for this.
Christian, a little bit later, we get a ton of Fed speak. Literally, they're lining up to comment, I imagine, on the CPI report at 8:30 this morning. Christian, are you going to pay much attention to that Fed speak? Is that important to you?
I think it is important because the market is very much looking to this to get a clue where the Fed really wants to go. Are there more hikes to come? How do they comment inflation? And we have seen that the Fed speak has been moving markets, especially last year as well. So from that perspective, yes, I think it's important to watch to also get their first reaction on this inflation data, which is coming out soon.
Christian, help our Western audience across the Atlantic, our American audience, with how Germany's coping. John, what's the number, 9% inflation?
It's a 9 handle, yeah.
Christian, I mean, I'm looking back to Willy Brandt and Konrad Adenauer. This is foreign and harkens back to fears of another time. What is the behavioral construct of Germany at this moment of 9% inflation?
Yeah, it's very, very high, right? And if you talk to Germans about inflation, there's always, as you rightly say, looking at history, there's some very bad experience with high inflation numbers. So it's a massive discussion. On the other hand, that's why it's probably positive that the government is supporting from the fiscal side, which has brought down inflation a little bit already. And we think top line inflation is coming down. Nevertheless, we have unions asking for substantially higher wages. So some in the double digits, so we talk about 10 to 15%. And that, of course, makes inflation quite sticky. So I think this discussion in Germany, in Europe, will continue probably even longer and at a higher level than we can see in the US.
Hey, Christian, great to catch up. Looking for 420 on a 10-year. What a call. Christian Nolting there of Deutsche Bank Private Bank. The CPI data coming out in a couple of hours' time. After that, we'll be catching up with the Federal Reserve. Mr. Barkin from the Richmond Fed. Mike McKee's going to be leading that conversation. I'll just be sitting there, Tom, trying to answer smart questions alongside Mike. But Mike will be the guy really pushing
he gives me questions.
A little bit later.
McKee
gives you questions.
He gives me questions out so I don't embarrass myself.
I just try and work off McKee's questions.
Yeah,
that's what
good.
I try and do. That's the job.
This is
a little bit later.
Every one of these guys is different on this day of inflation. I think Barkin's a good conversation.
And Tom Barkin, an hour after that inflation report. In the next hour, we'll catch up with Anna Hanna, Wells Fargo. Wells Fargo reckon the bear market is over. Anna Hanna coming up
Chris Harvey had that.
in the next hour.
Did it happen?
Looking forward to that conversation. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. NATO Secretary General John Stoltenberg says that Russian President Vladimir Putin is far from talking peace and is preparing for more war.
We see no signs that President Putin is preparing for peace. What we see is the opposite. He is preparing for more war, for new offensives and new attacks. So it makes it just even more important that NATO allies and partners provide more support to Ukraine.
NATO defense ministers are meeting in Brussels this week. They'll discuss spending targets Wednesday. Bloomberg has learned that Turkey plans to resume stock trading on Wednesday. The Istanbul Stock Exchange suspended trading February 8th, 2 days after a pair of powerful earthquakes jolted 10 provinces across Turkey's southeast and Syria. The quake killed more than 37,000 people across the region. Ford Motors laying off about 11% of its workforce in Europe. It's the latest sign of industrial disruption caused by the automotive sector's shift to electric vehicles. Some 3,800 jobs will be cut, most of them in Germany and the UK. The carmaker has reduced ranks in the region by 35% in the last 5 years. In the latest labor challenge for CEO Elon Musk, Tesla Autopilot workers in New York State have launched a campaign to unionize. Staff say they want to curb workplace monitoring and metrics. They also want better pay and job security. Leaders of the Starbucks union campaign are helping spearhead the movement at Tesla. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Even though we had no indications that any of these three objects were surveilling, we couldn't rule that out. And so you want to err on the side of safety here in terms of protecting our national security interests. I don't think the American people need to worry about aliens with respect to these craft, period. I don't think there's any more that needs to be said there.
John Kirby, The White House National Security spokesperson dialing back concerns about aliens.
I think at the Newport War College they didn't have they didn't have planning for that.
If you've not been around the last couple of weeks and maybe you've not been following the news, that's where we're at in the last week or so, Tom. Flying objects and the US military shooting things out of American airspace.
Yeah.
When have we ever seen that before?
The first time I ran into David Duchovny was at like a Walgreens or something at 2 a.m. And he was standing behind me. He was a very, very gracious, very great gentleman. But people, if you miss the X-Files, 30 years ago? Now's a good time to go back to season 1.
Has it been that long? 30 years?
Whatever.
I think it probably has.
See a very young Scully and a very young David Duchovny. The truth is out there.
From New York City this morning, good morning to you all. This is Bloomberg Surveillance. We may or may not go back to that story in just a moment. Allow me to set up the price action for you, just going into CPI a little bit later, 8:30 Eastern Time, so about 2 hours and 12 minutes away. Futures up by 0.25%, a pretty strong start to the week, wiping out the losses of last week on the S&P with Monday's session. Yields come in just a little bit by a couple of basis points. That's certainly not been the story of the last couple of weeks, though. Yields higher over the last couple of Fridays. If you go back to the morning of payrolls Friday, I think the 10 years up since then about 30 basis points. The 2-year, Tom, up about 40 basis points since that time.
Got 8 ways to go here. We're going to take a break here from the inflation watch, again with the green on the screen, and the VIX from a 21, almost 22 level yesterday down to 20.41. We're going to pause for a moment. We do this with Julie Norman, who's at UCL, University College of London, Baltimore Orioles fan, expert on American politics as well. And Julie, I want to step back to what you studied years ago, which is there was a very brave woman named Ferraro who took untold heat as the first visible woman in the vice president and presidential derbies. We move on from Haley of the Carolinas is going to make some kind of is Brainerd before Haley or Haley before Brainerd?
That I can't tell
We
you.
don't know. But tell us the span here of how we've become comfortable with women saying they want to be president of the United States.
Well, Tom, obviously so much has changed since the 80s. And I think, obviously we only have to look to Hillary Clinton as a real, kind of breaking any kind of ceiling that there was with having the presidential nomination, now obviously having Kamala Harris as vice president. But it obviously was a slow road. I mean, I would say there were a lot of assumptions about double standards, about different kinds of criteria that women would be held to, and I think were held to for quite a while. And I do think that is changing now. We see very different openness to different kinds of women leadership, and I think we see it in the types of candidates who are putting their names forward now.
In the heat of a Republican primary with what, John, 14 people? Lisa, help me here. 14 people, 12 people
some
running.
big names potentially as well, Lisa. We're thinking about what? Haley, Pompeo, Pence.
Yeah, big names. I mean, Julie.
Yeah, it's the irony that it actually
How
gives
is
Trump
she
a
going to
better
be
chance.
greeted by conservative America? I'm not so sure we've moved on. I'm asking you.
Yeah, it's an interesting question, Tom, but I think many in the Republican Party are very keen to show that it is is more of an inclusive party than the narrative sometimes projects, whether that's on race or whether that's on gender, other demographics. And so I think there are many in the party who are very happy to have a woman on the stage in the primaries, and will actually embrace that as maybe a positive thing for the GOP moving forward. Obviously, she won't appeal to all voters for all different kinds of reasons, some related to gender, sometimes not. But I do think things have shifted in a way that in either major party now, we can have a female candidate who's taken seriously.
Well, I think British conservatism changed that conversation decades and decades ago.
Yeah.
And since then, what have we had? Thatcher, May, Truss,
You
on
guys
and on and on.
light
on and on
years
and on.
ahead of us in Germany, but I would say, England is the analog, and we're not there.
Julie, I want to pick up on something Lisa just mentioned in a bit of crosstalk there, as we were talking about a packed Republican field. Does that just help the former President Donald Trump?
Well, in a lot of ways it does. I mean, it's almost counterintuitive because on the one hand, it seems like, okay, the party is opening up. There's a lot of voices who might be counter to Trump, different people that people could get behind. But at the same time, the wider that field gets, the more it actually, will likely give Trump a bump. We've seen that already in the polls. And if it's just Trump and, say, DeSantis head to head, DeSantis is usually neck and neck, often leading Trump. But as soon as you even put one additional candidate in there, Trump moves ahead. And the more diversified that field becomes, the more likely it will be that he will have a plurality majority. And so that's still very much a factor going into the primaries.
On the other side, on the Democratic side, we're going to get the greatest hits from President Biden this afternoon at 1:15 p.m. Eastern time, as he gives a sense of the CHIPS Act and the Inflation Reduction Act and more. And we will discuss that and more in a second. Are you expecting him to announce a run? Does it behoove him to announce earlier rather than later?
I think we can expect a run at this point, but I think an announcement this soon in would be a little bit premature. He doesn't really need to announce yet. There's not any likely competition to him. I think most Democrats assume he's going to run. He probably won't face a primary challenge. And right now he can, kind of keep coasting with what he's doing. And I think a run will, obviously when he announces that, will give a different kind of dynamic. And it's just one that he doesn't need to throw his hat in just yet if he doesn't need to.
We've been talking about how he may also announce Lael Brainard as the next Brian Deese to run his economic council and leave vice chair position at the Federal Reserve. Do you think this is a smart move, not only because she's a highly qualified person, but because of questions that it raises about the Federal Reserve and politicization at a time that's really fraught for the central bank?
Well, it certainly does. I mean, I think there's a couple of things at play here. One is trying to maybe think about what this means for the Fed on the one hand, which, as you pointed out, is obviously getting a lot of attention right now. But I think more of this is just having to do with Biden's own team. They wanted a shakeup. They wanted to move out, not only the economic leadership, but chief of staff and other positions that, just have a different tone going into these next 2 years. And I think we're seeing a little bit more of a shift into individuals who might be better off for Biden going into, say, a 2024 run than he's had in the past. So I think it's a little bit of both at the moment.
Julie, thank you. It's wonderful to get your perspective on these issues, as always. Julie Norman there of the UCL Centre on US Politics. Lisa, the leadership role perhaps the vice chair has been craving for quite a while.
Well, correct, right? That she potentially has more influence over policy rather than fiscal policy rather than just monetary policy. To me, it's not such a question about her role as the next Brian Deese, because a lot of people cross-border, cross-aisle basically say she's an incredibly competent, able person. The issue is, what does this do for the Federal Reserve at a pivotal moment, given that she has a leadership position on the Federal Reserve, and the Fed kind of has a difficult position this year. I mean, it really is facing off with some data that is very unclear. It has to make some real decisions.
So this is highly dependent on how the economy evolves, but I'm a little bit more interested in what it means for the administration than I am the Fed.
Really?
I do think it would be quite interesting, Tom, if we get an economic downturn that people begin to blame the Federal Reserve for, including members of the president's own party, when his top economic advisor might be the vice chair from the Federal Reserve who led some of that effort.
That's a good question. Does she have sort of a tarnish around her with the transitory and then the shift there into a much more hawkish stance? Of course, she was one of the more dovish members and was sort of on the more almost on the edge of dissent, as Tom would say.
There was no dissent.
Well, there was at least a sense that she was pushing back a little bit. Do you disagree?
There was no dissent.
Cumulative.
I can't sit there and say I wasn't inside the room. I don't know how much pushback there was, but there was no official dissent, and that's all I can say.
But the balance of risks was different for her than the rest of the board, it seemed.
Can I butt in here and say what he's acquiring today if they make this announcement? I have the clearest memories of the late 90s when Lyle, you didn't know if it was a she or a he, out of MIT, and Brainard Riker were writing brilliant policy pieces on labor, multinationals, and jobs that were definitive. And she was a kid. He's bringing into the White House, if he does this, absolutely our #1 academic on the micro theory, the applied economics of labor and international trade. You think we need that with China? Just possibly.
Highly competent individual. Equity futures are positive 0.25% on the S&P 500. We're about 2 hours away from inflation data in America. Equity futures looking a little something like this on the S&P 500. Important morning for US inflation data just around the corner. Equity futures elevated by 0.25%, trying to build on the gains of yesterday on the Nasdaq, up another 0.4%. Of course, the future of this session highly dependent on the data point, which comes out a little bit later in the bond market. Your 2-year, 10-year, 30-year a little something like this. Yields lower by a couple of basis points on a 2-year, 4.55 in yesterday's session on a 2-year yield. That's a new high for 2023. Right now, sub 450 at 449.47. 2 hours away from inflation data in America. The big banks have put out their estimates. We've put them all together for you. Goldman and JP Morgan, top of the pack, Tom. So that's Ferro over at JP Morgan, looking for 0.5% alongside Hatsias. This is month-on-month core. And this is what Wall Street's going to be very focused on in the coming hours.
Got to be gasoline coming back, and everybody's been warbling gaily about used cars. This is one idea.
Well, Lisa's been on topic, on point. And Lisa, you're right to pick up on that point.
Yeah, I've heard that I'm also the life of the party because of it. I will say, though, that it's not just used cars. It's also other cars.
Well, you did say that you were having that conversation over dinner. You know, used car prices.
I do. Okay, fair enough. And I think it is an important conversation because it's the sort of empirical evidence that shapes people's notions and expectations of inflation.
Not saying it's not important, just wondering about, you know...
my conversational capabilities at dinner time.
You know, with the kids.
Yeah. Take it away, Tom.
We've got an interesting day here to get you to the importance of 8:30 this morning. We're thrilled to tell you Stephen Stanley of Santander will be with us after Michael McKee. And then we move on to Kenneth Rogoff. That means international economics, the dynamics of U.S. inflation. And with Bruce Kasman of J.P. Morgan and Columbia University, we can talk about the linkage of Maury Obstfeld, Kenneth Rogoff, and then on to Bruce Kasman, young Kasman years ago with Obstfeld at Columbia. Bruce, what's so important here about Obstfeld-Rogoff is they attempt to tie it together. What does U.S. inflation this morning mean for the rest of the J.P. Morgan world?
So we're looking for a reasonably high side number with a 0.5 gain on the core. And I think you put that together. And I'd also like to include the January activity data, which have been coming in strong, and we expect it to continue to do so. And I think what it's telling you is this economy is not moving in a straight line down on growth, and it's not moving in a straight line down on inflation. And we should understand that these moves that we saw at the end of last year probably were overstating the underlying shifts in trend. We do think inflation's moving lower. We think it's going to sit this year somewhere in the 3 to 4% range. That's a big positive step. It's not enough for the Fed, and that becomes a big issue as we go forward from here. What
happens to our viewers and listeners' economy if we stick at 3 or 4%? If we get a more sustained, not 2% inflation, what does it mean for GDP?
So first off, we're not believing the economy is sliding into recession right now. We think there's a significant part of the inflation decline which reflects fading supply shocks, which is a positive. We think the private sector, particularly the business sector, is still very healthy. And I think importantly, and this is where we get into the call, we don't think the Fed's trying to kill us. So we do think the Fed is going to lean against this. But even though inflation is going to be above its comfort zone this year, we don't think it's going to act in a way that's going to try and drive the economy into recession. There's obviously a risk that they do that over some point in time. I've been starting to talk about the world as a boiling the frog scenario where you do get recession, but it's later and it's with higher rates than the markets are currently expecting.
Well, let's talk about the nature of that recession, because on one hand, if it's a deep recession, it'll cause cuts at the Federal Reserve and other central banks that fuels the next leg of a rally. That's at least what people certainly believe. But if it's not that deep, is it enough to allow the Fed to actually cut rates from wherever they end up?
Well, let's just start with the first point, which is I don't think we're in recession now. I don't think we're going to be in recession in 3 months from now. And I do think the Fed's going to be under continued pressure to raise rates. The market is looking for rate cuts in the second half of the year. And I don't think you get that unless the economy is tilting into recession. And I think the odds of that are still probably less than 50%. So we should start with that, because I think there's way too much discussion about recession and thinking it's going to come immediately. I think you want to wait for it and believe that it's going to take some time. I do think when the recession comes, probably the biggest thing to realize is it's not going to be like the GFC. It's not going to be like the pandemic shock. And probably the big issue here is whether it's going to be synchronized. The key thing globally, certainly, that determines whether recessions are shallow or not is whether the U.S. is in recession and Europe is in recession at the same time. And I think we have to consider whether or not the same kind of dynamics that are driving the Fed are going to drive the ECB and Bank of England. And right now, it does look like that's a likely scenario.
Bear with me, for this is kind of nuanced, but can the Fed cut rates if we don't go into recession? Let's say we get to what you expect, the 3 to 4% inflation read by the end of the year in the U.S. Is that enough for the Fed to say neutral is lower, let's go lower, and sit there for a while to see how far we can go down?
No.
Okay, then.
No, if the economy is not in recession and inflation is in the 3 to 4% range, you're not getting a Fed that's easing. And quite frankly, I think what's going to happen there is people's estimates of neutral are going to be starting to go up because you're not going to be getting the damage done to the economy that you would have thought with a high interest rate. You're not going to be getting the disinflation that you had hoped for. So this is a dynamic which is going to keep the Fed high for long. It's going to put pressure on them to keep moving rates up. And I think the basic point is that's going to happen until something breaks. My point is it's going to take time before something breaks. We're not imminently at a risk of going down.
In the meantime, if something doesn't break and people are able to get income, get paid to wait, go into cash, and there still is plenty of liquidity in the system, whether it's because of the Bank of Japan or somebody else, are some of these high rates even inflationary in and of themselves because it gives people more cash to play with?
I think we have income effects which are positive when the Fed raises rates. I think the dynamics of having a higher cost of capital, of weighing on activity, is a bigger effect. But, you know, one point that's really important here, and you're right to point it out, is transmission on different channels is different at different points in time. Certainly over the last year, the rise in interest rates, mortgage rates, has been a much bigger negative than the rise in rates. If we go through a period now where the Fed is raising short rates and long rates aren't going up and the economy is holding up, then I think you do have less damage being done by higher interest rates, and you do have that positive income channel to think about.
Bruce, John and I went back and forth on this weekend, and John was really taken by what Larry Summers said about transitory, and this is a different kind of inflation. You and Ferroli write about supply changes. We've come out of the pandemic. We've had supply shocks. So does that mean it's not a Korean War into Eisenhower deflation? Does that mean it's not the fears of the 60s and pre-Volcker inflation and that it's something different?
Yeah, I think we have to balance here. There's a set of things that damage supply and created huge dislocations in the economy that are now unwinding. The rate of inflation that we got to in the middle of last year is not sustained, and it's coming off, and it's coming off pretty quickly. But I do think we should recognize that we've had supply changes here that are going to linger, particularly labor supply. By our estimates, we've probably lost something like 2.5 percentage points of the labor force over the last 3 or 4 years relative to its trend. And that is not coming back. Also, we've changed psychology. We've probably changed production chains globally on a more permanent basis. And I think in order to get inflation all the way back into the low to mid twos, I think you are going to have to see some damage being done that we would call a recession. The thing I think is very different is I think the political economy compared to the 60s and 70s is not tolerant of high inflation. So I think eventually the Fed will do this and will create the dynamic of a recession. I don't think we're going to have elevated inflation the way we had it then. But there are supply damages being done, as was the case in the 60s and 70s. We are living with high inflation, and it's going to be somewhat painful to bring it back down.
Tell me about potential GDP then. I think we've had two once-in-a-lifetime ideas. Ferroli's let on this was sub 2% potential GDP. Do you adjust that given the stimulus, or do you just assume we're going to meander down in a long-term Bruce Kasman way to that shocking Ferroli statistic?
Yeah, well, Mike and I have been working with a potential growth rate in the U.S. which has been somewhere around 1.5%. Basically for the last decade. And I don't see any reason to change those views. There's obviously slowing demographics. We've damaged immigration flow in a more lasting way. The big wild card, of course, is what's happening to productivity. The numbers are really hard to read in terms of trend. I would be agnostic here. I'd say I'm a productivity pessimist, but I don't really feel like I should be sitting here taking a very strong view, and maybe we'll be surprised. We could be surprised to the upside. I just wouldn't bank on it, and that could help us. But again, I'm not sitting here feeling comfortable pushing in that direction.
Hey, Bruce, always a clinic. Thanks for being with us, mate. Bruce Kasman there.
Thank you.
Of JP Morgan, going into inflation data a little bit later. Just a clarification. I don't quote Summers on the weekend.
You
just never
this weekend.
Never. Quoting Larry Summers on the weekend. Antonio Conte, maybe, but, Larry Summers.
It was a transitory moment over lunch. Tell us about this big game today.
Absolutely not.
John, I think for Americans, this is completely foreign. The Tots of London are flying to Milan.
Tottenham, yeah.
to play
knockout
the AC
game
Milans.
to play AC Milan, not
in
AC
the
Milan.
Premier League.
Champions League.
Is that a bigger deal than
It's a
Premier
European
Seriously?
competition.
Is it a bigger deal than Premier League?
For some clubs it is. For AC Milan it certainly is.
But not for the Tots.
I mean, I think Tottenham haven't won a league title for how long, Tom?
Do they play their best players? Because they have one
without
guy
a
that
doubt.
was injured
No.
with a knee.
You play your best players.
You play your best.
If you
This
can,
is
if
like
they're
a big
fit.
deal.
A huge
It's
deal.
not like a friendly.
Knockout stage is huge money if you advance. Really, really
Where
important.
can I watch this epic?
You can watch that, I believe, on Paramount.
Paramount. Okay.
Yeah, if you'd like to dabble in that
And
a little
AC
bit later.
Milan did really, really well early, but
And now not so much. Those two
much.
teams are not in form, let's put it that way, at all. And AC Milan used to be a giant of European football and now not so much. And Tottenham were never a giant of European
When do we learn who wins the
See
Champions
these subtle
League?
digs that just getting nothing back.
Is Rihanna
I think in May,
halftime?
May, June
It
time,
goes
usually the
forever.
end of May.
Do the players get upset that they're playing for like 3 trophies? I mean,
No, they want to play in the Champions
NFL
League.
is like 1.
You want to play in the Champions League.
Okay.
If you're getting transferred to a club and you really have ambition, you want to be in the top 4 team to go into the Champions League.
Come on, more is better.
Are we done here?
Even better, whoever wins, Lisa, gets to go to Disneyland Paris.
Yeah, exactly.
I still don't
Patrick
understand that.
Mahomes.
Why did Mahomes just fly straight to Disneyland Paris? Is that just like tradition? What's that about?
Can't imagine.
Because didn't Brady used to do that too?
I'm not an expert on Disneyland.
I remember
trips
Brady and Gronk
afterwards.
used to go down to Disneyland Paris.
Yeah.
Not Paris, but
It was like
Orlando.
an endorsement thing. You know.
Is that what it was? It was an endorsement
Oh
thing?
yeah, I think so.
Oh, they got paid to
yeah.
go there?
Oh, huge. Oh yeah, huge.
They couldn't just celebrate. Is it not enough to win the Super Bowl? You have to get paid to go to Disneyland.
They get when they have their Tang Zero in the morning, they get paid. I don't.
You think that's
I
what
have
they
to pay
drink in
for
the
my own
morning?
Tang Zero.
Tang Zero. Can you imagine if Tang offer you a promotional deal?
Oh my God, can you imagine?
We'd never hear the end of it.
Yeah, exactly.
I mean, my question would be, have they already?
No.
Are you taking checks from Tang?
Mike said to me, Mr. Bloomberg said to me,
Dude,
Tom,
I'm
you can get paid by Tang if I get paid by Cheez-Its. That's what he said.
Is that what he said?
That's what he said.
I once asked to trademark "Good morning, good morning," and he said, "If we can make money from it, you're not making money from it." Equity futures on the S&P up 0.25%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The United Arab Emirates energy minister says supply problems among some oil producers could tighten the market next year as demand rises.
I truly believe that we need more supply in the future. With the increase in demand, the forecast for this year, definitely there will be an increase in next year.
The energy minister spoke to Bloomberg at the World Government Summit in Dubai. Indian income tax officials searched the New Delhi and Mumbai offices of the BBC today. This just weeks after the British broadcaster aired a documentary about the 2002 Gujarat riots and Prime Minister Narendra Modi's alleged role in the violence in his home state. An Indian government official with direct knowledge of the matter described the visit by tax officials as a survey, but didn't give any other information. The supplier of batteries to Volkswagen and BMW could reap billions from President Biden's electric vehicle bill. Northvolt joined a group of European companies putting policymakers on notice about the allure of U.S. green tax incentives in Biden's Inflation Reduction Act. The tax credits included the law cover about 30% of cell manufacturers' operating costs. If the Swedish startup built a similar size factory in North America, it would save about $8 billion in tax credits by the end of the decade. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I'm not worried about the demand. I think what worries us is, are we going to have enough supply in the future? I truly believe that we need more supply in the future. With the increase in demand, the forecast for this year, definitely there will be an increase in next year.
That was the UAE energy minister on the energy situation at the moment after a big rally last week in the oil market. Crude up by more than 8% over the week. Here's the tone of things right now. Crude pulling back a little bit by about 1% on Brent, by a little bit more on WTI, down by 1.6% to $78.86. About an hour and 44 minutes away from the CPI report here in America, the inflation report just around the corner, and yields come in just a little bit elevated in the last couple of weeks. We're down a basis point. Your 10-year 368.83, your 2-year through 450 in the last couple of weeks. 455, the high of the session, high of the year in yesterday's session. We break 450 this morning, down a couple of basis points to 449.26. Equity futures trying to build on the gains of yesterday, up another 0.25% on the S&P after delivering a gain of more than 1% on the S&P 500 in yesterday's session and taking out the losses of last week. Some tremendous research out there, as always, this morning from Michael Hart at the team with a Global Fund Manager survey. There are so many juicy tidbits in here. I'm going to pick out one for you. Recession odds peaked in November 2022 at 77%. They've declined to 24% in the past month, and we're down 27 percentage points month over month. So that's a big, big change. And something they point out when you look at the chart, note the prior peaks in recession fears coincided with the start of major bull markets in asset prices. So they've plotted this chart, see all these peaks in recession fears, the one back in November 22, there's one in April 2020, and there's one in March 09. I've had a lot of you write to me on Twitter, and I'm with you. Of course, the difference between November 22, April 20, and March 09, Lisa, is that we had actual recessions.
Yeah, exactly.
in March 09 and in April 20.
This is a unique moment, and I think that it's fair to say that. I do wonder what the contours of a new bull market would look like at a time when does big tech really take off in the same manner? If the Fed isn't cutting rates, if they're actually still hiking rates, what does that mean for a bull market for valuations that are starting from a pretty high place?
And valuations are starting from a high point. I think that's probably a key difference between those periods as well, Tom.
I think the ambiguities now are off the chart. It can be in equities, it can be in bonds. We had a 5.02% ask on the 6-month T-bill this morning.
That's amazing, isn't it?
I don't believe we had a 5.02% print, but there it was on the Bloomberg screen, BTMM Go. That's stunning, Lisa.
Yeah, especially given the fact that it was what? Zero? Not that long ago.
Not that long ago, but it's the first time I've seen a 5-handle. Thanks to Ben Emmons for pointing that out. Joining us now, Will Kennedy on hydrocarbons, Senior Executive Editor for Energy and Commodities, with a real grasp to it. Will, I want to tie in your expertise with what the shock is for our viewers and listeners. Owner's equivalent rent, Will, in the United States, which is sort of what the pros use to gauge rent, is gone from a 2% inflation to 7.5% inflation. In your world, a gallon of gas off the bottom, it came down nicely, is up 10.4% off the AAA regular gas as well. How dominant is hydrocarbons in the inflation picture that you and your team report on every day worldwide?
Well, I think the real problem for hydrocarbons, not the problem, the real issue is it's the price that people, especially in the US, feel most acutely. You're most exposed to the ups and downs of prices. You see it every time you go and fill out your car, something most people do once or more than every week, and it's there right in front of you. So I think when prices of gasoline rise, people really feel it in a way perhaps they don't notice other price changes, which makes it absolutely crucial to people, how people are feeling about inflation.
We're on the edge of spring, edge of summer. What does spring and summer look like? Do we have a handle on supply-demand dynamics, or is it a mystery?
Well, obviously, those are the peak seasons for gasoline demand, especially in the US, the so-called driving season. Things tend to pick up at that time of year. I think people are feeling okay about the outlook for supply-demand balances this month, but I think there's some concern about how things might develop in the second half of the year as demand continues to rise and supply remains constrained. We got Russia cutting production by 500,000 barrels a day, OPEC saying they're going to keep policy unchanged until the end of the year, backdrop of low investment across the industry and shale that's sort of underperforming expectations. And you put that together, and I think a lot of people do still see a lot of tightness in the second half of the year, even though after a good start to the year, food prices are a bit mixed.
Well, amid this mishmash and this confusion, with the sense that perhaps oil prices are going to go even higher, what is the purpose right now of the United States releasing more of its strategic petroleum reserve when it was supposed to be refilling it?
No, exactly. And they had sort of, when prices were down at the end of last year, they had actually got a window under their own price guidance to refill, and they missed that, and now another 26 million barrels a day is coming onto the market. Now, those barrels are actually something that were mandated as far back as 2015 to finance some other spending, so it's not actually related to President Biden's decision last year to start draining the reserve. But of course, it keeps lowering the amount of oil left there. It makes it harder to fill it back up, and it will lead to concerns that that strategic reserve is not being used strategically and will remain much smaller than it was for many years to come.
Well, you said something important there. They missed the window, and a lot of people think that they're only going to get further away from it, especially as we get more clarity around whether China comes back online and as people continue to fly around the world with airline traffic rising to new records. What's your view on what the new window will be for this administration, or will they just not refill the SPR at all?
I think it will be hard for them to refill the SPR if prices develop as we've discussed. It will be expensive to do, and they'll have to find the money. And ultimately, for the reasons that Tom said at the start about how important gasoline prices is, A, to inflation, and B, perhaps more importantly, the politics of inflation, it kind of probably suits them to keep the oil coming out and not putting it back in, even though it stores up risks for the future in many people's opinion.
Well, I don't have the knowledge in front of me, but in the blur of the news flow, I'm getting the feeling that LNG is still challenged after 125 years of promises that LNG is going to save the day. What's the state of liquefied natural gas to being a legitimate business? Aren't there people saying it's just too expensive to do?
LNG, I think LNG is very important to the global system. We've seen that this year as the US has managed to export its gas surplus into world markets, and that's really what solved the European energy crisis, this flow of LNG across the ocean. Now, is it the answer to everything? No. Is there enough LNG coming onto the market over the next few years? No, you're right. The market looks very, very tight. And in fact, we continue to see this mismatch between US prices, which are rock bottom, and European prices, which are much harder. And that reflects the fact that the US doesn't have as much export capacity as the market could use. But what it does mean is it provides a considerable energy advantage to the United States over the coming years. We're likely to see a scenario where the United States benefits from very cheap natural gas for the time being, and Europe doesn't.
Hey, Will, we've got to leave it there. Thanks for being with us. Will Kennedy there of Bloomberg, going into inflation data a little bit later this morning. Energy a key part of all of that. Crude right now, Brent, down 1%, Lisa, 85.63. WTI down 1.5%, just short of 80 here at 78.93.
Covering the oil market makes me want to tear my hair out. I can't understand the machinations of this at all. It's incredibly difficult, especially given that now the UAE is coming out and saying they're not worried about demand. They're worried about supply. Well, shouldn't that push prices even higher? I mean, honestly, I'm just missing the plot a little bit.
Tom, are you missing the plot?
I'm missing the plot in that I think commodities is part of it. And the two statistics I brought up earlier, what the pros are not talking about, Kasman and Ferroli at JP Morgan, it goes into their math, but they're looking like everybody else. What's the Fed going to do? Does Lyle Brainerd matter? And our viewers and our listeners are like, wait a minute. OER's up 7.5%, which sounds about right nationwide. And, yeah, we came off the bottom, up 10% on a gallon of gas.
Let's get to the headline. Nikki
There's the
Haley.
headline.
It's official. She's in the race. In the race and a first challenger to the former President Donald Trump. Get excited. It's time for a new generation. Let's do this. The video is out on her Twitter account. Join Team Haley, Tom, at Nikki Haley for President. There you go. It's official.
482 days before the British would announce the first person.
For what it's worth, it was set to be announced tomorrow, wasn't it? And Axios came out with the video a couple of minutes ago. So Nikki Haley on the move already.
All right, who's next?
Who's next?
Exactly. I mean, that's all that matters, sure. This field's going to be big, Lisa.
It's
going to be really big.
And very competitive.
More coverage on that just ahead. And we catch up with Anna Han of Wells Fargo. Remember, Wells Fargo out yesterday saying the bear market, what bear market? It's over. That conversation is coming up as we count you down to inflation data about an hour and 34 minutes away.
I think the markets have been mispricing the Fed for a while now.
We don't think the Fed is done.
How high does the Fed need go? It needn't go too high, in part because of the confidence it's instilling in investors and the public.
Effectively, I think what we're seeing is that things are actually improving around the world.
Maybe nothing happens and we just have a plain run-of-the-mill recession. That's my bet at this point, if we have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I think the markets have been mispricing the Fed for a while now.
We don't think the Fed is done.
How high does the Fed need go? It needn't go too high, in part because of the confidence it's instilling in investors and the public.
Effectively, I think what we're seeing is that things are actually improving around the world.
Maybe nothing happens and we just have a plain run-of-the-mill recession. That's my bet at this point, if we have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Happy Valentine's Day.
Oh,
it's a
so
beautiful
sad.
thing.
Oh,
That's
thank
enough
you.
of that.
Yeah.
CPI Day
That's the
from
same.
New York City. Good morning, good morning. This
How
is
are you?
Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Let's get straight to this market. Equity futures up 0.2% on the S&P 500. TK CPI just around the corner. A lot of people expecting this one to stay somewhat elevated.
Yeah, I think the whispers are somewhat elevated. I'll let McKee decide what that is. But, you know, the way the market closed yesterday, I think maybe there was a swing back off of Friday where people are saying, okay, it's elevated, but we're all going to live and move forward. That was sort of the 2 p.m. angst yesterday.
Rallied into the CPI report. Big day of gains yesterday,
Yeah.
and at least we've said this a few times this morning, but last week was the biggest week of losses we've had on the year, and we wiped them all out in yesterday's session.
You said this yesterday, that the fact that the biggest weekly loss of 2023 was 1%, it basically gives you some sense. And heading into CPI, how much is this market poised for some sort of disruption? And I say this particularly with services sector inflation and where that comes in, given some of the earnings that we've seen from consumer-facing companies that keep delivering upside surprises, particularly vacation types of
The chairman of the Federal Reserve has sat there twice now and said the disinflationary process has started.
In goods.
Does this morning's data contradict that or support it?
That's a great question, because even in goods, he said the disinflation, he clarified the second time, disinflation process has started, but just in the goods side, the services side, we haven't really seen it yet. Maybe, we'll see. But we will get a sense of whether we start to see some of the goods side reinflate at the same time that services side sector continues to be really strong. And I say this, Marriott just came out with earnings. They beat expectations. We have seen this again and again.
And Tom, Coca-Cola as well. Decent numbers from them. PepsiCo was it last week, and Coca-Cola delivering a similar story.
I'm doing the math right now, John. It's, you know, the 10-year track record is what these two arch competitors face at. And I'm sorry, PepsiCo's clean Coke's clock. I mean, there's no other way to put it. I look at it, and it's all great. Organic revenue's up. Their free cash flow is absolutely unacceptable. And many, many other, you know, you look at the Disney focus that we had.
Yep.
Bob Iger, timeout chair. Okay. Nobody's doing that with Coke, and I've never understood it. They did not deliver on free cash flow.
The stock is up in a pre-market. by
Yeah,
1
everybody disagrees with me, but I'm just saying on a 10-year per year basis, I got Pepsi at 11.6% and Coke at 8% something.
As soon as you said that Pepsi is cleaning Coca-Cola's clock, I immediately Googled who owns Tang, and it's Mondelez.
Oh, no, Mondelez, they
necessarily
send it to me. They
biased.
send me a case every 90 days.
No, he's not, you know.
Where are they?
He's got a contract that says he can't speak about Mondelez. You know
Yeah,
that,
because
right?
clearly, I mean.
He can talk about Coke and PepsiCo, just not Mondelez. Equity futures right now are 0.2% on the S&P. Going into CPI a little bit later. Yields come in about a basis point on a 10-year, 3.69. Keep going back to yesterday's session to see the 2-year Tom at 4.55. That was something.
Well,
that was something.
You know, Coca-Cola's there is a distraction, but John's absolutely right, folks. It is about the fixed income market. The 2-year yield, 4.50%. We saw for a brief moment here on BTMM Go, the acclaimed Bloomberg Terminal short paper function, John, 5.02% as an ask on the 6-month piece.
Have we got a countdown clock, Tom? We 87 minutes.
To what?
Is that
AC
what it is?
Milan and the Tots?
I'll start that clock after CPI.
Okay, thank you.
87 minutes away, Lisa.
That's exciting.
And we are going to dig in 87, or it's 86 minutes now. 8:30 a.m. we get U.S. CPI for the month of January. We are going to be looking at the underlying components pretty carefully, not just the year-over-year composition. Month over month is more important than year over year. How much do we see some sort of dramatic response in markets? And this really is my question. How fragile is the rally that we've seen year to date date to some sort of upside surprise in the CPI print that we get later this morning. Today, we also get a host of Fed speak, including in, I believe, if we get the countdown clock, what is it? It is 173 minutes, 153 minutes until Tom Barkin comes on at 9:30 a.m. on Bloomberg Television with Jonathan Ferro and, of course, our own Michael McKee. Also, Dallas Fed President Lori Logan at 11, Patrick Harker of the Philly Fed at 1 p.m. And then, of course, we get John Williams of the New York Fed at 2 p.m. What do they say? Is this just, basically groupthink? We're going to raise rates 25 basis points and another 25 basis points. The market seems to be in some sort of agreement. We're data dependent. Or do they come out and give some sense of a willingness to go even more restrictive, that they're not yet restrictive in the face of inflation that does seem to be persistent? And at 1:15 p.m., we get President Biden speaking about a whole host of issues in Washington, D.C., perhaps chips, the Inflation Reduction Act, especially in light of what we have been seeing with respect to international competition with Europe. But you raised this really good question, John. What's he going to say about Lael Brainerd? How is that going to inform both his potential run in 2024, but also a strategy for a Federal Reserve where she was a more dovish voice?
The clock is up, Lisa. I can see it now. 1 hour and 24 minutes away, just looking at it on the screen. Bramo, thank you. Looking forward to that address from the President a little bit later. Joining us now is Anna Han of Wells Fargo. And Anna, I'm not going to bury the lead. Your research yesterday, first line, the bear market is over. Anna, let's go straight there. And thanks for being with us. Why is the bear market over?
When you look at the signs in the market, you're seeing the credit spreads compress. Something that's pretty rare in this time when the market's expected to fall into a recession. You're also seeing that volatility has been pretty contained on the equity side. These are the kind of factors we look at, and then we point to what everyone loves to point to, which is a strong labor market and declining CPI or inflation metrics. These are all lining up to be not the bear market that we saw last year. So that really explains the first part of our title of our new note.
And if we get a breakout on this, if we get some form of, a movement from a bear market to who knows what, right now the hope and prayer day-to-day basis has been a short squeeze. We may see that this morning with a constructive CPI report. When and how do we get beyond a short squeeze?
No, you're absolutely right, Tom. What's been leading the market is really the stuff that has not performed well, the unloved, very highly shorted names. They had a very strong bounce to start the year. But to see this rally extended, we really need to see leadership change from not just a bounce in what had really underperformed and was having sort of this, dead cat bounce, as we call it. But what we need to see is actual sustainable earnings growth driven leadership. And for us, that's not as easy to find in the large cap market. Perhaps we like to size down and look more in the mid cap space, and we think that we'll find some better undervalued growth opportunities there.
Do we underestimate, particularly if we get some form of persistent inflation, what nominal GDP into revenue growth is going to be? Coca-Cola just had revenue growth in their fondest dreams they'd never admit to. Granted, free cash flow wasn't there, but organic revenue growth is an act of God. Is that the great underestimation of your bull market call?
Absolutely. The inflation and how long the CPI can really persist or perhaps stay longer than what the market is currently pricing in, and therefore, in a way, push out future rate cuts. These are all things that we have to consider when we think about revenue growth and earnings growth, because especially in this kind of environment, when we were looking for positive signs, we don't want to fall for that honeypot of a trap where things will seem to be growing and then only to find out that this was more of a inflation-driven metric rather than actual volumes increase in sales combined with actual consumer strength. So these are all the signs that we're looking for as well when we look for what could possibly turn our scenario into an extended bull market.
This is a really frustrating bull market, I imagine. You said that it's a bull stuck in traffic. It sort of gives you the sense of frustration that everybody feels with. Even if you get some gains, it's going to be a pretty motley picture in terms of which sectors and how much things actually go up. So can you give us a sense of the dispersion you expect this year, akin to what we saw last year in terms of sectors outperforming and underperforming?
Well, I think last year the dispersion was quite great, particularly in the sectors that traditionally have done pretty poorly. Think about the traditional defensives. Now you come this year, and I think that leadership has changed again. You aren't seeing these typical defensives being the leader You're seeing them quite lagging the market in some senses. But we think that actually is an opportunity to pick up some defensive exposure, particularly more in the pharma space. It's had a bit of a rough start to the year, but at the same time, we're not ready to pour on the risk in our portfolio. So we like something that can act defensively, has a little bit of an improved valuation, an improved technical standpoint, but also, like we said, has that more defensive earnings growth aspect that can plow through, especially if we see even further slowdown in earnings growth later this year, if rate cuts have to get pushed back, if tightening starts to weigh and we see the delayed effects of those monetary and policy changes.
Just real quick here, Anna, how do you view what happened with January, given the fact that unprofitable tech companies performed the best of anything?
I think the main thing here, Lisa, is look at the cost of capital. This is what we continue to emphasize with our clients. There's two aspects here. If you look at the drive of cost of capital, the 10-year yield coming in 40 basis points to start the year, that kind of move has to, in a way, be reflected in the equity markets, and seeing that rally in the more growth-oriented sectors, especially the cyclical sectors, that's actually a healthy sign to us. It's telling us really equities and rates, they are still working in a way paired off, like teeter-tottering like they're supposed to. On the other hand, if people are concerned really about the fundamentals having been the main driver of equity returns last year, then people continue to be concerned about fundamentals who aren't convinced by what we've heard in this latest earnings season. That could be a reason why to continue to stay bearish, but that's not our base case right now.
Anna, it's a pretty nuanced call, and I appreciate the clarity this morning from you and the team. Anna Han of Wells Fargo, working alongside Chris Harvey, and making a call in the last 24 hours that the bear market is over. We are about 1 hour and 20 minutes away from inflation data in America. Lisa mentioned we'll hear from the president a little bit later. We may also hear from the president on Lael Brainerd, the current vice chair of the Federal Reserve. Our team here at Bloomberg reporting she's set to be announced perhaps as soon as today, maybe later on over the next week, as the National Economic Council Director, replacing the outgoing Brian Deese. The other piece of news we got in the last 20 minutes or so is the first official challenge to the former president, Donald Trump, to make a bid to become president. Nikki Haley, former UN ambassador, South Carolina governor. Get excited, Tom. It's time for a new generation. Let's do this. Out on Twitter about 20 minutes ago.
I think we got to get used to the new generation angle. It'll be fast, and particularly with what President Biden does. But that seems to be the huge issue. In her 50s, DeSantis is 44.
So this is the first official challenge. Then we're thinking about DeSantis, Pence, maybe Pompeo.
7,
already in there.
10.
Hey, we're going to find out.
Lisa, are you thinking about it?
9, 10, 11.
The fear is it going to be a circular firing squad for the Republicans?
That sounds brutal.
Is that what happened last
time? You
time?
would frame it that way.
Well, no, but like it's the whole question of whether people cancel each other out and then you pay
that what happened
for former
8 years
President
ago?
Trump, right? This
Yeah.
is really the question.
If they dilute the field.
Thank you. That's a more graceful way
The
of saying
support
it.
for the former president is going to be so sticky through the primaries,
Correct.
you think?
Yes.
Yeah, so it's going to make it difficult.
We'll talk about that in just a moment. David Balin in the next hour, the CIO and Global Head of Investments at Citi Global Wealth, with inflation data coming up at 8:30 Eastern Time.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. NATO Secretary General Jan Stoltenberg says that Russian President Vladimir Putin is far from talking peace and is preparing for more war.
We see no signs that President Putin is preparing for peace. What we see is the opposite. He is preparing for more war, for new offensives and new attacks. So it makes it just even more important that NATO allies and partners provide more support to Ukraine.
NATO defense ministers are meeting in Brussels this week. They'll discuss spending targets Wednesday. Bloomberg has learned that Turkey plans to resume stock trading Wednesday. The Istanbul Stock Exchange suspended trading February 8th, 2 days after a pair of powerful earthquakes jolted 10 provinces across Turkey's southeast and Syria. The quake killed more than 37,000 people across the region. Ford Motors is laying off about 11% of its workforce in Europe. It's the latest sign of industrial disruption caused by the automotive sector's shift to electric vehicles. Some 3,800 jobs will be cut, most of them in Germany and the UK. The carmaker has reduced ranks in the region by 35% in the last 5 years. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
We are still far from achieving price stability, and I expect that it will be necessary to further tighten monetary policy to bring down inflation down toward our goal. Doing so will likely lead to subdued growth in economic activity and some softening in labor market conditions.
Still waiting for that softening in the labour market based on the official data claims and that blowout payrolls report from a couple of Fridays ago. That was Michelle Bowman, the Federal Reserve Governor. Tons more Fed speak coming up later. We'll touch on that in just a moment. Equity futures right now up 0.2% on the S&P. 1 hour and 12 minutes, 47 seconds away. Thank you. Just working off the clock. Yields come in a basis point on a 10-year, 369. Your 2-year yesterday, nicely through 450 at 455. It comes back down just a little bit today, and some dollar weakness off the back of that comes through. Euro dollar 107.50, Tom. We're positive there about 0.25%, and futures positive too by 0.2.
We get lucky right now. What we do is we book guests. We've got a wonderful team, and they're working sometimes on the 10-minute or at the length of a 1-hour basis, but sometimes they're 3, 4, 5 days ahead of dragging onto the show really competent people. Right now, with this announcement of Lael Brainard moving to the White House pending, it is perfect to speak to Heidi Krebo-Redeker with the Council on Foreign Relations, Adjunct Senior Fellow, but far more than that, somebody with a Beltway understanding on her path from Dartmouth and LSE to different services for our government. Heidi, thank you so much for joining us. I was talking with John and Lisa about the Brainard I first knew, with David Riker writing about trade and labor policy, the effect of American multinationals. What a perfect time to have someone like the gentlelady from Wesleyan join the White House team because of China. What will Brainard say to the president about China?
Well, first of all, thanks for having me on the show. And Lael Brainard is a huge win for the White House. As you were talking about earlier, she's experienced. I know that there's no steep learning curve. She has incredible experience on domestic and international, White House, Treasury, academia, and she knows all the people around her. So she's worked closely with Jake Sullivan. She's worked closely with Janet Yellen. And on China, I think she has a great depth of experience. And that's it's important because this NEC has sort of merged with the National Security Council in how it's looking at national economic policy.
What does that mean for the Treasury and the role in formulating policy, Heidi?
So I think that if Lael is announced, and I think she is likely to be later today, she and Janet Yellen go way back. So any bumps in the relationship with Treasury, I think she could easily smooth over. I mean, this is it's a big position. It's stepping in to be the head of the National Economic Council. It's a very powerful role. And it is a convening role. So she will be sitting, advising the president on both domestic and international economic policy. I think that it's a good move for Treasury. It's a good move for the White House.
That said, some people are looking back to 2021, where there was some political interference alleged as to why the Fed didn't raise rates sooner, that perhaps if the Fed chair, Jay Powell, had been renominated, he would have had the conviction to go forth more quickly. Do you think that the disruption in leadership may cause some sort of ongoing hindrance to the Federal Reserve if someone isn't nominated to replace her in the near term?
So I think they are going to have to find a good replacement and really, a heavyweight, because this is this vice chair position. It's not just Lael. It's not just any governorship. I mean, we've had Stan Fisher there, Janet Yellen in the past, and I think that they will go probably centrist. So a heavy hitter and someone centrist, not someone really necessarily, from the far left.
I'd love to get your comments, Heidi. We're talking a lot about Lael Brainard, but we also just talked about Nikki Haley announcing her run. And I am curious whether you really see this as an incredibly crowded field that makes it more likely that former President Trump actually has a more legitimate chance at being the Republican candidate in 2024?
So I think, you know, I was a little surprised that she announced with the video just a few moments ago, Nikki Haley. But it's a very crowded Republican field, as you noted, and we'll have to see. I think, you know, the big concern is, does the field divide itself so much that it enables, you know, former President Trump to really have a clear path to be the nominee? I don't know. But I think, you know, the tendency in the Republican Party right now is to say, no, that's not going to happen. But we've seen it happen before.
Heidi, I want to talk about the generational shift here. A guy named Richard Haas has a new book out. I think you got the first copy of the book. Haas said, shut up and read it. The book's right behind you, no doubt. You got the copy. And what Richard Haas is talking about is a social construct of the nation and our need to return to foundational civics. Okay, great. We're in the process of a generational shift in our politics, in our economics, dare I say, in our banking as well. Are we ready for the generational shift?
I think we're planting the seeds for that generational shift. You know, I would look at you know, one of the greatest things we've done for enabling a generational shift is really what the president is going to be touching on in his speech later today, which is a generational investment in our own economy and our future, in R&D, in advanced manufacturing, in setting the groundwork for really the next great wave of innovation coming out of the U.S. So I think, you know, that is certainly one of the bigger stories today, and for the next year, what we're doing in our investment in our country.
Heidi, do you think we're doing it in sufficient size? China was very brazen about the Made in China program they unveiled many years ago. It ended up getting a lot of criticism, perhaps unexpectedly so. They were that brazen. And Heidi, I wonder, from the plans you've seen so far over the last couple of years, from this administration and the former one as well, are they being bold enough here in the United States to counter what China is trying to achieve?
So, I mean, I think it's hard to underscore just how important not just the 52 billion going into chips, but the 280 billion going into the R&D, the 370 billion going into Inflation Reduction Act, and this is meant to be catalytic capital. That catalytic capital is a huge opportunity. It's meant to bring in private sector funds. It's meant to bring in investment across the spectrum, from startups to helping reshore our technology in the U.S. So I think I think we are doing enough if we use those catalytic funds to really take advantage of capital markets, which are, in addition to innovation, we have deep capital markets that can play into this massive wave of federal funding in a way that's beneficial.
Heidi, this was super smart, and I hope we get to do it again very soon. Heidi Krieber-Rediker there of the Council on Foreign Relations, Tom. And I think the lead point there, just the merging of the NEC and the NSC and some of their priorities with China at the epicenter of it. It's pretty fascinating to see how Vice Chair Brainerd is going to transition from focusing on monetary policy to going back to looking at balloons being shot out of the sky and what to do about it.
Really well said, and what it speaks to is a generational shift in these institutions. Krieber-Rediker is pro at that. She's like totally wired into the beltway structures, the pros, the cons of it. And what she said there about Brainerd knowing everybody in the room, I think is just absolutely critical.
So true. Critical. A big leadership role for Vice Chair Brainerd.
A different leadership role than what Gene Sperling had a long time ago. I'd let Mr. Sperling speak for himself. But there's something new going on here, as you mentioned, the merging and the dovetailing of this.
Equity futures right now up 1/3% on the S&P. Inflation data in America about an hour away, with yields coming in a single basis point, 368.64. Coming up next, Sonal Desai of Franklin Templeton. An hour and 22 seconds away from the inflation report in America. Thanks for that. Going going to keep counting for
What
you.
will you look for when the report comes out?
I will look for month-over-month core
Month-over-month.
initially, and then we'll work from there and look at Supercore. Is that helpful?
Yeah, that's.
Mike McKee's going to guide us through it in just a
Supercore
moment.
like a super official number, or is
It's becoming one.
it's becoming?
It's like then there's Powell's number, you know, very specific stuff. Depends what you want to call it. Equity futures look like
You
this
can
on the
guide
S&P.
me.
I'll do my best. Mike will as well, and so will Lisa. It's a team effort, Tom. It's a beautiful thing. Futures up 0.25%. Happy Valentine's Day.
Oh my God!
On the Nasdaq.
You're scaring me.
410. So is this too nice? Let's get straight to it. Switch up the board and get to the bond market now. 2 year, 449.26. We're coming a couple of basis points. 2 year yesterday, I've said this a few times, 455, a new high of the year. I have to say, we have had a move of about 40 basis points off the lows of 2 Fridays ago. This equity market hasn't budged too much off the back of that move. We were down about 1% and change on the S&P last week and then took it all back in yesterday's session and some. If you switch at the board and finish on euro dollar, we'll get to the currency market, Tom. Euro dollar looks like this. 107.60, that currency pair positive, a third of 1%. Just a touch of dollar weakness out there as yields retreat going into that inflation print. Would you like some estimates, Tom?
Please, I'm on the edge of my seat. Yeah.
Month-over-month core, which the Wall Street economists like to predict, forecast, that obsess over, and they go even deeper than that. So we'll start there. Take out food, strip out energy, 0.4% is the estimate. The previous month was a revised positive 0.4. That's all your good month-on-month stuff. The headline that you probably see in the newspaper, that's going to be headline year over year, and we're looking for headline year over year at 6.2%, down from 6.5 TK. They're the estimates so far.
It frames it out nicely here, and we'll get to the CPI here in an hour as well. I've got equity there. I guess we crack open a Coca-Cola and listen.
Oh, nice transition. I like that.
When was the last time you had a Coca-Cola?
A Coca-Cola. I could not tell you.
I would guess.
I couldn't tell you.
5 years.
5 years?
Yeah, that much.
It's been that long? I think it's probably in the years. It's definitely in the years.
We weren't allowed as children really to have it. It was like
no, we weren't either.
Like a luxury.
It was bottled water. Because my dad was Italian, so he did not drink tap water. That was just a thing, even if
Did you
tap
have
water
the
was
orange
safe, so
Italian
it was
orange
bottled.
thing?
Which was that?
Pellegrino or
Orangina.
Orangina, yes.
We used to have
the rich kids had Orangina.
The treat was iced tea when we went to Italy. You know, peach iced tea. Do you have that? That's a good one.
My father used to get a 2-liter bottle of Coca-Cola and pretzels anytime anyone was sick, and then he proceeded
Okay.
to
he'd have it.
So that was for him. That was his medicine.
He'd be very excited. He'd be like, you need to really drink a lot. So he'd sit there and do that. All right, let's talk about Coca-Cola.
It's really speaking to our childhoods, this is. Okay, carry on.
Let's talk about Coca-Cola. Happy Valentine's Day, Dad. Coca-Cola reported fourth quarter organic revenue that actually beat expectations. Also, really in line on the upper edge of the forecast, what they're expecting. It's up about 0.8%. But again, it speaks to consumer spending. It speaks to the ability to outperform. And perhaps it speaks to this ability of continuing to look past some of the potential weakness, crossing a low bar and getting some enthusiasm in equity markets. Marriott's particularly interesting to me because we have seen the consumer spend, which we'll see in CPI in terms of services, continue to be very strong. With Marriott, business travelers are returning, and we hear this from everyone. People are getting back on planes, and they're going to visit clients. And Marriott is benefiting because they pay a higher rate when they get some of their hotel rooms. Shopify, also interesting to me. It's up about 40% so far this year, up 1.6% in pre-market trading. They were among the first that cut workers.
Yeah,
and
layoffs.
Now people are expecting them to benefit the most, John, from those cuts. This is really where the rubber meets the road. Have tech giants cut enough to really become a sort of justifiable size? Are they basically getting the tailwind from some of those cost cuts?
And will it show up in claims? So we get claims a little bit later this week on Thursday morning. Initial jobless claims, we're looking for a number of 200,000, up from 196. Now, granted, if we get that number, that would be the second week where claims have started to lift. But TK claims at 200,000 historically is just ridiculous. And
it's still ridiculous.
That's not even population adjusted.
And
200,000 is just a bonkers low number.
Yeah, and McKee told me years ago, pay attention to jolts to overlay on top of claims, and we'll do that as well. But what we're not talking about is retail sales tomorrow. Some people are waiting more than what we're going to see here in 55 minutes, 42 seconds.
You guys are really on a roll.
I've got a clock. It's a great thing.
You know, I don't know what to make of that. To me, CPI is still ascendant, but nevertheless, retail sales. And retail sales, like Coke revenue, is nominal. McKee again has told me that.
So
I don't know any of this.
Lisa mentioned this yesterday. Torsten Slock of Apollo did over the weekend as well. We get some credit card data from various firms. You get some card spending data from Bank of America as well. Mike Gapin put out the research. Total card spending per household at 5.1% year over year in January. That's why they forecast a 2.6 month-over-month spike in core control retail sales over at Bank of America. And as you know, Tom, that number, core control, that's an important input into GDP.
Well, let's do this. Let's bring in Mike McKee. We're going to speak to him here in the 8 o'clock hour, but we're going to speak to him now here 1 hour ahead. Frame this. There is a media frenzy over what we're going to see in 54 minutes, 49 seconds. I don't buy it for a minute. For guys like you, is it just another report?
It's a little more than just another report, given the situation we're in here with the Fed. But unfortunately, or fortunately, depending on how you look at it, there's going to be some oddities in this number, and so it becomes a little bit less important in the sense that the Fed, because of the seasonal adjustments and the weighting adjustments and the fact that energy prices rose some, will be looking beyond this report more than they do in a normal situation like this where it could be critical. They also have another CPI coming out before their next meeting. So, yes, it's going to be very interesting, but I think the markets have already priced for it for the most part, unless we get some huge surprise. And the Fed is going to be waiting for additional data. So it makes a great story for us, but I'm not sure it makes a big long-term difference.
We're going to catch up with Sonal Desai, Franklin Templeton in just a moment. I wanted to squeeze in one more question. I talked about headline year over year, talked about core month over month. Do you think this market responds to what you've been talking about for a while now, where you strip it all out? What's it called? Supercore, the Power Core? What is
it's kind of become the word supercore.
What is it?
It's service. It's core services. Take out energy and food, and then take out housing services, and you're left with basically most of what people spend money on. And because housing is so uniquely calculated in the CPI, it's a distortion to what the inflation rate is. So you take everything else out and you see what's happening with services, and most of that is driven by wages. So the Fed is keeping an eye on what's happening with wages and whether that's pushing up inflation. And that's the measure they can find that will tell them that.
Okay, because people got nuts about this, and you know that. It's like stripping out all the stuff we need.
No,
energy, food, and shelter.
No, but
they just strip it all out.
You bring it up. This is really important, folks. This is the heritage of Bloomberg surveillance. We're going to do this without hysteria.
Sure,
it's a big deal report. Everybody's waiting for it. If you're not part of the market, folks, trust me, it's Inflation Tuesday.
Inflation Tuesday.
It's Inflation
Has that replaced Payrolls Friday?
No, it hasn't, but it's amazing how many. Tomorrow's Retail Sales Wednesday. Roses go on sale.
They do.
They do.
That's when you buy
Folks,
them.
this is very important. I know, Amy, you're prepared for this. Tomorrow, roses on sale, February 15th. Look for that. There's your Bloomberg reporting for this morning.
How's everything going at home?
Oh, it was good. What's great about it was you have the martini, you just throw the olive. You know, it's just great.
Throwing olives in the house.
You throw olives in the house. Vet Bill's going around eating them as we go. Right now, we're going to go to someone. This is really well done here. Franklin Templeton, thank you so much, Amy, for making this work. Sonal Desai is the Chief Investment Officer of Franklin Templeton Fixed Income. And this harkens back to the moment you're living now where everybody's got international on the brain. And a guy from Tennessee out in the Bahamas and up in Toronto long ago and far away with the Templeton Growth Fund and then the Templeton World Fund. Sonal, thank you so much for joining us this morning. Quickly here, is 2023 a year that Sir John would enjoy? Is it a year for international value?
I think probably, and I'm not going to commit too much in terms of equity here because, as you know, I'm not the right person to talk about equity and with any great expertise, but I would actually have thought that last year would have been his kind of year. Absolutely.
You know, one thing that I'm struck by is financial conditions easing to early 2022. And this is something that Torsten Slock over at Apollo pointed out this morning as well. What do you make of this at a time when you do see banks tightening some of their lending conditions, where rates are so much higher? It's counterintuitive. Can you frame out how problematic this is for the Fed?
I think it is problematic, and actually, this is something after Chair Powell's last press conference, I noted in something that I wrote, he did not address what I thought was the elephant in the room, which was financial conditions. We had already unwound close to 425 basis points of Fed rate hikes. Powell continued to say that financial conditions had tightened. They had tightened only in comparison to where they were in the extremely easy period post-COVID. Well, we're not in the post-COVID period, so I think it is pretty problematic. Mortgage rates are off their highs. I would say that we've seen the type of rally in the first month of the year, 8 to 10% in equities, close to the same thing in fixed income. It's very easy, and the dollar has depreciated. Everything added up together, it's a problem for the Fed.
So now, can we just wrap things up?
Consumer confidence should follow
On this
right?
one, because you were so good last year on saying there's upside risk to the Fed's hiking cycle. You were so good the year before talking about inflation not being transitory. You thought it would be sticky. So now I just wonder, based on market pricing, alongside Fed projections, do you still see there to be upside risk, significant upside risk to the terminal rate?
So, significant, no. I'd say that we're probably at least going to go to 525, 550 and then pause. I'm glad to see the market has come back towards thinking about at least 525. I think then the Fed will pause. What I think there might still be upside risk to is year-end inflation expectations, where the market, pieces of the market are already coming back to somewhere between 2 and 3. And again, it's nuanced, right? I think that at the end of this year, we will still be closer to 4 than to 2, and that's going to probably be unacceptably high. So I think we need to really price out those rate cuts fully from the second half of this year, and those need to remain priced out.
So now, thanks for jumping on the phone for us. And again, fantastic year ahead series in Barron's over the last couple of months. Really enjoyed that. Son of Design there of Franklin Templeton. TK, she's been right the last couple of years. Upside risk to inflation, to the terminal rate at the Fed, and now maybe that stickiness in inflation into year end is going to push out some of those rate cut calls in this market.
You see it in tea leaves across the curve, John, and right now, and this to me is truly historic, coming off the pandemic, and frankly, getting back to where we were in 2006, a 6-month T-bill off the Bloomberg, it's a printed 5.013%. Wow. That is the statistic of the morning.
How much time on the clock? What's left?
48 minutes, 10 seconds.
Nice.
Oh my God.
Inflation data just around the corner.
Inflation Central.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Police say a gunman killed 3 people and injured 5 others at Michigan State University's campus in East Lansing Monday night. The suspect was later found dead after apparently taking his own life. Police say the 43-year-old shooter was not affiliated with MSU. That investigation is ongoing. The U.S. Environmental Protection Agency says Norfolk Southern may be liable for cleanup costs related to the derailment of a train carrying hazardous material. The derailment started a massive fire in Ohio earlier this month. A Norfolk Southern spokesperson says that it will continue to perform or finance environmental monitoring and remediation. Bloomberg has learned that a former Credit Suisse employee copied and took personal data from other staff members, including details of their compensation and bank account information. The company warned of the breach, which took place some years ago, in a letter to employees. The staff member had legitimate access to the data at the time and transferred it onto a personal device in breach of Credit Suisse policies. The supplier of batteries to Volkswagen and BMW could reap billions from President Biden's electric vehicle bill. Northvolt joined a chorus of European companies putting policymakers on notice about the allure of U.S. green tech incentives in Biden's Inflation Reduction Act. The tax credits included in the law cover about 30% of cell manufacturers' operating costs. If the Swedish startup built a similar-sized factory in North America, it would save about $8 billion in tax credits by the end of the decade. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The fact that the consumer has so much still accumulated savings, now these savings are coming down, but I think that's actually widened that lag period for the consumer to actually start to cut back on spending. And I think they are starting to cut back, but the labor market is strong and I still have accumulated savings. When those savings run out, in our view, that happens in the second half of the year, that's when the consumer starts to cut back.
Priya Misra, Global Head of Race Strategy at TD Securities. Honestly, TK. Why did you ask that?
Because we're going to do a car thing here, and I've never known how to pronounce.
I've got no idea if the mic was hot or not. Anyway, futures on the S&P. We'll get to that, whatever that was.
Yeah.
Just a moment, just in case you missed it or you heard it. I don't know. Up 0.25% on the S&P. Yields come in a basis point on a 10-year, 368.45. For those of you interested, Supercore. Miami Key left the building, but he gave us this little piece of information. If you have a Bloomberg terminal, I know many of you listening do. So the ticker for Supercore, so this is CPI Core Services less housing month on month, is CSXHPCM Index. If you want that again, it's CSXHPCM Index on a Bloomberg terminal, Tom. Is that helpful? Helpful for me anyway, because a lot of people are going to go through this report and they'll probably want that number instantly, and we'll do our best to get that out for you.
And tomorrow we'll have retail control group, which is sort of the same idea.
The input into GDP, yeah. Which Mike Apron's looking for a punchy number off the back of a decent credit card spend in January.
Can I just say, this is all just new ways of stripping out the disposable income that people have, right? Basically, how much disposable income do people have and are they spending?
Yes.
So this is just the cleaner way to say it's a way to strip out all of the base costs. How much do people have left over and how much are they willing to put out there?
I wonder what percentage of Americans think this is absolute baloney.
They think it's nuts.
Nuts. It's nuts.
Well, overwhelmingly so. I mean, I said that a couple of minutes ago. We're stripping out all the stuff that people are highly dependent on. Food, energy and shelter. It's insanity.
Today it is as well. 41 minutes, 52 seconds away from all this. Thank you for joining us. We're going to digress. We're going to digress to the emotion that someday you too could have a Ford or a Chevrolet. And I was interrupting John as he was going to air there. John, is it a Vauxhall?
We used to have a Vauxhall, yeah.
Vauxhall.
Not me personally. We had a Rover. We had a Rover 416. That's what we have.
It's a cultural thing, folks. And David Welch and Keith Naughton kill this for Bloomberg here. That guess what? New cars, and dare I say even some used cars, are only for the rich. Joining us now, Craig Tudell on the inflation in core cost automobiles. What percentage of Americans, Craig, can afford, or for that matter worldwide, can afford a new car?
Well, they're awfully out of reach for more and more Americans. I know my old Oldsmobile that I started out with now, is not, obviously they're not around at all. But, the existence of an affordable new vehicle, it's really, really sparse. Even on the used side, we're in a situation where the amount of supply out there because of the crazy circumstances of the last couple of years of the pandemic, where the car was the ultimate social distancing device, right? And so we saw a lot of sopping up of used car supply, and on the new side, obviously we haven't been able to replenish dealer lots because of the fact that the manufacturers have had the chip shortage to deal with, and that's really continued to hamper them on the production side. Even when they're able to produce more, they're at least saying that they won't go back to their old ways of overproducing, putting a bunch of incentives on those cars and selling them at losses or really thin margins.
Craig, increasingly many manufacturers introducing EVs. Craig, can you tell me how that started to influence the number, if at all?
Yeah, absolutely. I think, just sort of very simply, it's still much more costly to build an electric vehicle with a battery powertrain than a combustion engine powertrain. And obviously, this is moving. I think the expectation is that there will be a sort of crossover in the next few years, depending on the segment. And there are a lot of ways to sort of slice and dice that data. But for the time being, it's still much more expensive for manufacturers to make electric vehicles than combustion vehicles. And we're in a situation where, we talk about supply-demand dynamics being very sort of off balance for the market in general. In electric vehicles, it's even more extreme, where you have, some people waiting months, even more than a year for their EV that they want to buy. They can't take delivery because manufacturers are having trouble keeping up with that demand.
How do you think the proliferation of EVs, Greg, will change the used car market? I just wonder, some of those cars without warranties, the replacement cost for some of those batteries is ridiculously expensive. What do you think this could mean for the used car market?
It's a really fascinating question. There are a lot of puts and takes there. I think Corey Cantor at Bloomberg Neff has done some really interesting work on this recently. Folks who are subscribed to Bloomberg Neff and on the terminal ought to look up a recent report that he's done on this. I think, in broad strokes, there were a lot of concerns in the early days of EVs about residual values and whether EVs would hold their value because of those concerns about how costly it is to replace a battery. You saw also just a lot of lease deals, right, where these were sort of compliance cars that weren't particularly attractive, didn't have a lot of range, and so there wasn't a whole lot of demand for them. You saw manufacturers, put highly incentivized lease deals on these just to move the metal, and that, just obliterated their resale value. We're now in a situation where there's still a lot of question about how much these are able to hold their value. I do think that, the sort of naysayers who dispute whether or not EVs will ever, hold up as well as combustion cars. You look at what Toyota has done with the Prius or what Tesla has done with some of its EVs. I think, maybe with the exception of just recently when they slashed new car prices, before that, they really had strong resale values. And that was, really standing out when you crunched the numbers and took a look at how EV residuals were trending.
There's another aspect to the higher prices, and that is by strategy. A lot of auto manufacturers are producing less, being more selective about which cars they put out there, putting more expensive models out there. At what point will this become a political issue where suddenly you'll get this sort of pushback? Guys, make some more cars for the common American, the common individual across the world, rather than just sticking with the high margin products.
That's a great question, and I particularly hear it more over here in Europe, and I think I would attribute that to the fact that there's real concern about, sort of creeping relevance of Chinese manufacturers. You're seeing more and more Chinese automakers start to export, more of them taking a look at Europe, and real concern on the part of executives of, look, Carlos Tavares at Stellantis, the owner of Jeep and Ram, he's talked about the idea either we need to bring the cost structure of European manufacturers down to be competitive with China, or we need to, take a good hard look at whether or not we need to put up trade barriers. And so it's all sort of very reminiscent of, decades ago when we were talking about, the Japanese and then Korean manufacturers, looking abroad and looking at markets in Europe and the U.S., real concerns about, cost structures in China, leading to, say, a Mini built here in the UK not being competitive with one built in China.
Here we go again, it seems. Greg, thank you. As always, Greg Trudell there. Certainly, Tom, some of these Chinese manufacturers, some of these local brands are becoming more and more popular on the mainland. The huge effort we've seen from some of the more established brands out of Europe, out of the United States, to make inroads into China. I just wonder how much they're going to be crowded out in the years to come.
It's been there forever. This is like a conversation from 50 years ago on Japan. To me, it's just manufacturing. It's a labor arbitrage, a phrase I'm stealing from Stephen Roach. And what's interesting here is not so much China, Europe, which I totally don't get, but China manufacturing to Japan or other places on the
sort of
rim.
Perverse irony of this all, though, is that right now the reason why Germany may not turn against China is because they depend so much on selling their cars to China. If they become less competitive with respect to selling their autos in China, does that actually increase some of the tensions where you start to just get outright bans?
Can I make this granular?
Sure.
I mean, I don't even look at the car names. All I know is a $47,000 Kevin Bacon.
I saw that.
Okay,
You're talking
Kevin
about the commercial in the
Bacon's
Super
Bowl. I think
okay.
with his daughter, the great actor Kevin Bacon. What it comes down to is $931, 35 months on the grid, something like that, auto payment for 4 years,
right,
which is $11,200 per year you have to pay to buy a Kevin Bacon. And, take the other cars as well. How much of America can afford a Kevin Bacon?
My frustration with the way the EVs have been rolled out, are we seriously saying a Hummer is good for the environment just because it's electric? Is that seriously what we're going to say?
I've never bought it. Where do you get them charged in Manhattan?
Seriously.
Seriously.
There are charging stations. There are charging stations.
There are.
You're asking me. I don't have an EV, but
they're down
off
Chelsea Pier. Everybody's got to drive to Chelsea Pier to charge up.
Charging isn't the issue, not in major urban centres. I think the issue is just how environmentally friendly they actually are.
Yeah.
Some of these are massive. They're huge.
Incoming hate mail.
CPI data up next.
I think the January data in the US is essentially going to come in strong.
There's a possibility that inflation goes back up.
When the dust is settled, inflation may also be persistently higher than what we had before the pandemic.
If core services ex shelter remains strong, which is our view, the Fed is not stopping yet.
We have the Federal Reserve doing the job to end the period of free money and put us back on a more realistic course.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most important Valentine's Day, outshone by inflation here in 29 minutes, 16 seconds. We are steeled for it. And, John, so was the equity market voting yesterday afternoon, and the vote continues this morning. Futures lift up 14.
There was a vote in the bond market as well, 455. On a 2-year. Yields elevated over the last couple of weeks, pushing higher going into CPI. Then on to retail sales tomorrow. So we're looking for CPI to come in without the deceleration month on month that people are hoping for. That's the estimate so far. Then on to retail sales and people looking for a punchy number there as well. Overwhelmingly, what changed the story for so many people was that blowout payrolls report. And a lot of people then started to push out their recession calls, bring back in the prospect of getting to 5% at the Fed. And we'll see if the inflation data and the data in the coming weeks changes that.
Global Wall Street, stay with us for this hour. Kenneth Rogoff will join us. We're thrilled to bring you Stephen Stanley, just magical on the granular data with Santander. But, John, to me, the conversation of the morning, and I wonder where are we in 1 day, 2 days, 3 days, was Anahan of Wells Fargo as Wells Fargo shifts their equity call.
They say it's no longer a bear market.
There it is.
And then Bank of America, they put out their fund manager survey a little bit earlier this morning, and expectations of recession have gone from like 77% probability, and they've been crushed. What are we now, Lisa? Where are we? The 20s, the 30s, just in terms of the probability in that report? Find that absolutely amazing. They point to the prior peaks of April 2020 and March 2009 and say typically when that recession fear peaks, after that, you get the start of a bull market. The pushback you'll get, though, to that report is that we haven't actually had a recession yet in America.
And the other pushback is, what kind of bull market is this going to be? I mean, even Anahan, maybe they're changing their forecast, but it's a bull market stuck in traffic, or maybe it's no, animal at all, because basically what you're looking at is a muddle through. I mean, our year-end forecast is 4,200. It's not exactly a screaming bull market that's going to cause some sort of incredible gains.
It's about the journey, not the destination.
Oh,
jeez. Oh, dear Lord.
Is that your Valentine's card for today?
That's what I wrote in the card this morning. It's about the
wrote
journey, not the destination. CPI's at 8:30, don't forget.
It's a sensitive Pharaoh with us today. We're going to get through this, folks, and try to last through 10 a.m., which we're all going to go have a wonderful Valentine's Day breakfast.
And then watch Milan versus Spurs a little bit later.
Spurs, very important after the surveillance. Nab, Lisa, there is an historic moment today. I mentioned this in the last hour. To me, it's without question the tea leaf of this morning. 6-month T-bill prints of 5.01%. You led on this 10 days ago with T-bills in general coming up. Forget about the 2-year. Further inside that in the land of Ira Jersey, what's that signal?
Well, bonds and stocks are voting for different things, right? I mean, on one hand, bonds are preparing for a much higher rate future, and they are bringing forward their forecasts for how high the Fed can raise rates. So when does this start to have a material effect on valuations? If suddenly there is an alternative, cash looks great, you're getting paid to wait, we keep hearing that. At what point does that fundamentally shift the risk-reward proposition for equities in a way that hasn't yet been felt?
John, my data point for this morning is we're 26 minutes, 8 seconds away from a key inflation report. What else should we look at?
We'll look at equity futures and just whip through the market action just briefly, up a third of 1%. Yields in a couple of basis points on a 10-year, 368. And in your FX market, bit of dollar weakness here, Tom. Euro dollar 107.65.
This is well timed. He is wonderful because he can go across assets. David Balin's with us, Chief Investment Officer, Global Head of Investments at Citi Global Wealth. David, how close are you to amending or tweaking your 2023 outlook?
Not very close, Tom. At this point, we just haven't seen earnings decline. Enough evidence of that. We've already seen earnings become disappointing. And I think that markets ahead of us are actually optimistic that somehow we're going to avoid a real slowdown in the United States, and that seems highly unlikely to us.
David, let's talk about this CPI data and what it could mean for higher terminal rates. A lot of people think there's upside risk. Sonal Desai said perhaps we get to 5.50 and then stay there. How do you frame that conversation for your clients?
Well, first of all, everyone's very fixated on the month-to-month change, and they're looking at everything, with great urgency right now. And this month, we could see a surprise on the upside because you have higher energy prices, that are, imminent with this last month. So what I think you have to do is you have to think about what the trend is. And the trend on inflation is clearly downward. And if we look month to month, that's one thing. But if you were to look over the course of the year, we could imagine inflation running at a 3.5% to 4% rate by the end of the year, and certainly, into the 3% range by 2024. And that's the trend that's upon us. And if that's upon us, then obviously that's a good thing for the economy. Right now, what the bond market is doing is the opposite. It's sort of saying, hey, rates are going to stay higher for longer. And that assumes that there is simply no slowdown in the economy right now. And as I mentioned earlier, that's unlikely to us.
So in other words, you think that the divergence between bonds and stocks errs more on the side of stocks being right and bonds being wrong. Is that what you're saying?
Well, what we're saying at this point is that stocks are optimistic. They're looking through an earnings trough, and they don't understand that it could be substantial. We're predicting that earnings in the U.S. could go down by 10%, right? And we're already on the way there. We already see disappointing prints in many industries over the course of the last several weeks. So if that's the case, I think stocks do have a leg downward. Take a look at the short position in the market right now relative to where it was in 2008 and 2009. We had a huge short position then, and we have an even bigger one now. So a lot of these rallies get carried ahead by that short covering activity.
So right now, what do you think the fragility is of this market to whatever the print is that we get in about 30 minutes time, 24 minutes?
Well, I think that the market, you take a look at the movements that have taken place in the 10-year. You've been at 440, you've been down as low as 350. All of those changes are happening within, just a month or two. And that to me tells you just how volatile the market is. But to your point earlier, one of these markets is going to be right. And we do think that it is the bond market. And if you take a look at its ability to predict recessions, with 90% accuracy, when you have an inverted yield curve as strong as the one that we've seen, it is very hard to ignore that. So I guess the answer, Lisa, is that we expect the bond market ultimately to be right.
Hey, David, I don't want you to comment on an individual stock. For this morning, it's Coca-Cola. But the bottom line is it's organic revenue growth to dream of. Let's call that a nominal GDP proxy. And free cash flow just isn't there. And granted, it's a lift in the market. But that's the dovetail, sustained organic revenue growth versus margin challenges. When you dovetail your security analysts into all your work, what do you say about those two conflicting forces? Great revenue and margins that aren't all that great.
Well, you would imagine in a market like this, Tom, exactly that problem for most companies, right? Their ability to maintain pricing power, which they had during the pandemic, was absolutely clear. And now that's fading. Their ability to actually raise prices to maintain margins is actually fading. And that's happening in many of the consumer industries, any place where there's a lot of inventory. And remember, we do expect actually that retail sales can go up and down by the weather as well. And this was obviously a better month for weather. But the truth is that the amount of actual consumer spending is heading down in real terms. And with that, margins will head down. And I think that's another example of why earnings on a forward basis, certainly for the next 3 to 6 months, are actually on a downward trajectory.
So, David, if that's the case, where's the haven right now within the equity market? Where do you find safety?
Well, safety is a very important thing. And the way to find that is in stocks that don't have that problem. Let's just take the pharmaceutical industry, where you have a combination of high and growing cash flow, you have the ability to maintain margins, and you have high dividends. And that may bore people, right, for the moment, because there's so many of the stocks that have done well this year are the real laggards that have did very, very poorly for the last 3 months of 2022. Those stocks that are tried and true beat the market last year. I think they'll beat the market this year. And at the end of the day, the only time that we want to be, heavily invested in some of the, higher beta parts of the market is when we see that we're at the trough of those earnings and we're looking into 2024 and our expectations are materially higher. We just haven't gotten there yet. And people are very impatient.
David, a lot of people are coming on programs like this and saying, buy T-bills. Could you just go a little bit deeper than that and tell us whether it's a little bit more effective to buy, say, an old 2-year with a 12-month maturity left on it? Can you just run us through that? What works best?
So the first thing and the most important thing to tell everyone is that they should be investing their cash, because lots of clients have way too much cash. And whether it's a 6-month or a 2-year or whatever, that's what they've got to do. But there are so many opportunities now to lock in yields from 2 years to 10 years. Investment grade credit, preferred stocks, lots of the, bond market is really, really rich. And I don't think we're going to be at these rates when we're here, just a year and a half from now. So the critical thing is to realize that bonds are back, that the idea is that we want to have a full allocation to them, and we don't have to take a whole lot of credit risk. So if I were advising a family today, it would be, to be out on the 5 or 10 year range, because you can always trade that in. You can always trade that in for other bonds or for equities, but you can't get these yields a year from now.
David Balin of Citi Global Wealth. There are various tax-efficient ways of doing that, but ultimately that's the conversation. That is FOMO, yes, Tom?
That is bond FOMO.
The fear of missing out,
yeah.
Sure.
It's fascinating. It's amazing just how we get jaded here, folks, because we're grinding this out every day. Where were we a year ago?
Well, to your point, Tom, on the FOMO, I think the point that David's trying to make is if you took, say, let's say you take a 12-month T-bill right now, or even 6-month. What David's saying is that he doesn't think these yields are going to be around for long. So 12 months from now, you won't have the opportunity to take 5% again. He's making the point you go further out on the curve. That just depends, Lisa, on whether you think this is real regime change or not. Whether you think we're going back to the days of 2019 pre-pandemic, or things are going to change.
That's the reason why people say on the short term, it seems like a clear buy. People are just basically giving you a victory lap, Tom, with respect to triple leveraged all cash. But at the same time, they're saying longer term, we don't know, right? Because we don't know what the new regime is. We don't know what kind of real yields there will be, as well as where the inflation rate will end up. That is the vague aspect. And then you have the likes of Christian Olting, who came on earlier and said he sees 420 on a 10-year. So that would actually be quite a bit of pain, at least from here to there, if someone went into the longer duration.
What's on the clock? 18 minutes and 36 seconds.
Yeah, 6 months just printed up to a 5.02. I got an announcement. We've been really dealing.
Oh, here we
on
go.
this.
Drum roll. What have you got?
Drum roll. Well, we've been trying to reposition triple leveraged all cash, and we got the triple leveraged all cash GPT ETF.
Nice.
It's in registration right now.
Nice. That'll get the inflows, TK.
We're looking at it.
No, I don't get it.
It's got what's a GPT with a cash?
You just put GPT on everything.
All I said was, look, I got to make 2 and 20
/AI.
Okay, I got to make 2 and 20. What's hot? They said all cash GPT.
I didn't realise that Stephen Stanley's gone to Santander.
Yes.
Okay,
yes.
Nice.
Yeah.
Nice. We'll do that in about 18 minutes. Looking forward to that. Inflation data, 17 minutes, 55 seconds away. Futures up.
Lord.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainian President Volodymyr Zelensky's embattled defense chief appointed 3 deputies as part of a shakeup aimed at cooling accusations over corruption in the top echelons of the government. Defense Minister Oleksiy Reznikov is doing damage control after officials under him were swept up in a probe looking into procurement violations and skimming funds. Since then, Zelensky has signaled support for the top aide as the country braces for a possible Russian offensive. Russia's nuclear exports have surged since the invasion of Ukraine, boosting the Kremlin's revenue and cementing its influence over a new generation of global buyers. Exclusive trade data compiled by the UK's Royal United Services Institute shows that Russian nuclear fuel and technology sales abroad rose more than 20% in 2022. Purchases by European Union members climbed to the highest in 3 years, from Egypt and Iran to China and India. Turkey is throwing its full weight behind stocks before its planned stock market reopening tomorrow. Bloomberg has learned the government is channeling billions of liras from pension funds and state lenders into the stock market and planning tax waivers for buybacks. That's part of a plan to contain the market fallout from the February 6th earthquakes that hit the country's southeast, killing more than 37,000 people in Turkey and Syria. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
It's about the labor market. The Fed is very concerned that the price increases are going to be sustained unless we really see a step down in the growth of the labor market, and that most recent jobs report suggests anything but that.
Randy Krosner there, the former Fed governor and current University of Chicago Booth School professor of economics. That payrolls report a couple of Fridays ago just shaking up things big time. for so many people. It's like you thought one thing and then the market rallied aggressively. You got that print and it's, okay, I need to restart 2023. Where are we?
100%. And then people in the equity market were like, never mind. And actually, San Francisco Fed came out with a report and they were like, actually, it was really due to the weather. There was a huge weather adjustment in terms of employment, and the people read that more closely.
Mike McKee can tell us about that in a moment. Equity futures right now up 0.25%. The inflation data is about 13 minutes away. Looking forward to that January CPI report. It's just around the corner with yields coming in a couple of basis points against the grain of the move we've seen over the last week, Tom, on a 10-year, about 368 right now. But over the previous week, a move of 20 basis points for the 2-year. And the 10-year, we saw some big moves.
It's really, really exciting. There's no other way to put it. I mean, I think it's really, really interesting, the gyrations. And I'm going to go back to the equity market and the lift yesterday. I'm not even sure why we lifted. We lifted.
We did lift,
We lift. I mean, there it was.
I'm not going to try and explain every tick. I'm not sure what yesterday was about.
I think that's a really important point. That's how stupid it's gotten. People are trying to explain every tick.
And it has got stupid. I agree.
It's gotten stupid. To clear us of the stupidness of it all, Stephen Stanley joins us now, Chief U.S. Economist, Santander U.S. Capital Markets. Steve Stanley, thank you for joining us with a brief here. You and I remember the idiocy where the world would stop M1, M2, M3. I think it was Thursday afternoon, long ago and far away. How silly are we being right now here 11 minutes, 28 seconds away?
Well, I do think there's a lot of seasonal noise in the data. We saw it with the January employment report. I think we'll see it again tomorrow with the retail sales numbers and to some degree with the CPI. And you had 3 very low readings to end last year and everyone got really excited about inflation is under control. And then last Friday, we got new seasonal adjustment. They ran the seasonal adjustment program again. And they revised up October, November, and December for the core. So all of a sudden, that downward momentum on inflation has kind of dissipated. And I think we're going to see more of that today. I'm looking for a 0.4 reading on the core with maybe some upside risk to that.
Stephen, this conversation about Supercore, can you just shine a light on some of the conversations you have with clients at the moment? Are they asking about that a lot? Do they expect an estimate from you? What do you say?
Yeah, people are definitely starting to try to focus on that. I think, the key here really is this housing piece. I mean, we're taking that out. It's over 40% of the core. So, when you take that out, you're taking out a pretty big chunk. But the presumption is that housing expenses are going up fast right now, but they're going to come off later in the year because of the lags involved. We know that the housing market has cooled off. And so people are wanting to focus on, on the other pieces in the core, but the broad point is that services prices tend to be very sticky and they've accelerated, and I think it's just going to take quite a bit of time for them to come back off.
With all of these seasonal adjustments, Stephen, and as we watch some of the upward revisions, even on the prior month CPI that's heading into this current report, are we going to look back and say there wasn't that much disinflation at this point, that was sort of a head fake at a time when services still were reaccelerating?
Yeah, well, if you look at what happened late last year, it was just a handful of very volatile categories that were pushing things down. I mean, gasoline was the most obvious one, but used car prices were falling rapidly. Airfares were falling rapidly, which was really the same thing as gasoline prices. It was the reversal of the big spike that we saw in energy costs after the Russian invasion of Ukraine. So you could see at the time that it was not sustainable, the low core readings that we were getting, the low headline readings that we were getting. And I think now we're getting back to something more in line with where the fundamentals are.
All right, so now we're going to get a Fed parade, including Tom Barkin joining John Ferro and Michael McKee coming up here. What are they going to say if this is a hotter than expected print?
Well, the Fed has actually been leaning against the market enthusiasm and saying, hey, look, this is going to be a tough task ahead of us. It's going to take quite a bit of time. So it's not going to be I told you so, but it's going to be, I think, much more steady as she goes for the Fed than it will be for the markets. It feels like to me that the Fed has really almost locked in a game plan here. They want to get rates just above 5%, which probably means 2 more quarter-point hikes. And then they want to pause and give it a few months and see what happens. And so I think the bar is probably relatively high for a divergence from that short-term game plan on either side.
Stephen, to the breathlessness, 8 minutes, 6 seconds away, is this idiocy? Excuse me, I editorialize here, John. Please excuse me. Sir John, I'm sorry. This idiocy, Mr. Stanley, of nowcasting. The beloved geniuses at Cleveland, who I adore for their work on inflation for 20 and 30 years, even they have dived into the value of nowcasting. Is there any statistical value to navel-gazing nowcasting?
Well, I guess we've all, as economists, we've all been doing that to a degree. I don't like to advertise my number on a day-to-day basis, but really, at the end of the day, the one price that we all can track very closely on a day-to-day basis is gasoline prices, and that is responsible for a good part of the high-frequency noise in the data. Otherwise, I think it's pretty tough. I mean, how do we know whether there's going to be an upside or downside surprise, for example, on shelter costs or recreation costs or medical care? I mean, we don't have a lot of data on that. So there's certain things that we can track and others that we can't.
You keep your nowcast a secret, Stephen. Is that what you do?
That's right. That's right. I can't show you everything.
Stephen, stay close. Stephen Stanley there of Santander. Mike McKee's our nowcaster.
Road trip.
Where to?
Stanley. The three of us.
Spain.
Seville. Spain.
I knew it.
I mean, come on. High-speed rail. Flying to Madrid. High-speed rail to Spain.
Free association.
The three of us, Steve Stanley, Miss Botan could stop by.
That works great.
Miss Botan could stop by.
Yeah, I'm sure she's excited for that.
Great.
Happy Valentine's Day.
Let's go to Mike McKee, the Federal Reserve Bank of McKee, on nowcasting. Is there any value to all this madness as we are now 6 minutes, 25 seconds away?
Yeah, not really. I suppose if some investors making an investment decision on a particular day might think so, but as kind of follow up to what Steve was saying, they teach you in economics school that you give a date or you give a number, but you don't combine the two in terms of a forecast.
It's nowcasting revised. I mean, these revisions are serious. We have great respect for what you're doing, BLS, and the rest of it. Nowcasting is like betting on the Super Bowl.
Well, it's a little bit.
The Chiefs, do they have a chance?
Yeah, it's a little bit like political polls in the sense that any political poll is a snapshot of the day that people were asked, and it doesn't tell you what they're going to think down the road. We look at the Atlanta Fed GDP now number all the time, and that's given the data that they have. Well, in January, we don't have any data, but they still put out a nowcast, so it changes a lot.
Can we have the snapshot of what you'll look for when this number drops in about 5 minutes? What will you look for immediately?
Well, immediately we'll look to see what energy prices did, because as Steve said, that was probably something that did drive things up, and then housing prices. But we'll look for that supercore and see what's happening there, because that's the thing that's the most important to the Fed. And a lot of other categories will go up and down, and we'll see what contributed to it. But overall, let's see what the Fed wants to see. Let's see what that tells us.
Lisa wants Supercore straight away. First number. Where is it?
I can't take it seriously.
Do you think the goalposts have moved? Do you remember, Lisa, when Chairman Powell said there's no space for nuance? And now all of a sudden there's space for nuance?
It's now slicing and dicing to such a degree. You strip out housing, you strip out everything but services, you strip out energy, you strip out
We did that
food.
when everyone said it was transitory.
And now
it was
people
just
are
like, cut this out.
Looking at this. And the bottom line is inflation has come down, but it hasn't come down that much. And I think that that's the takeaway. So now the issue is, does the Fed have to be more aggressive in their pushback?
I'm looking at year-over-year log supercore, and it really tells a story here. I'm sorry, from 0.9% to 6.43%. There's some real, it's dramatic.
Equity futures right now up 1/3% on the S&P. Your inflation report is 4 minutes and about 13 seconds away. With futures up and yields in, down 2 basis points. CPI data coming up next. Inflation data in America just around the corner, seconds away. Going into it, equity futures are positive by 1/3% on the S&P. Mike McKee seated and ready to go to break this number down for you. Yields come in 3 basis points going into the print on a 10-year right now, 367.12. I can tell you on a 2-year, down about 2 basis points as well. Sub 450, we're at 449. With your CPI data, here's Mike McKee.
Well, we're waiting for the CPI data to drop. And, of course, by computer, it just comes in right now. And it looks like we are pretty much bang on as expected. A 0.5 gain for the headline number after a 0.1 gain in the month of December. Of course, that was revised last week. The core comes in at 0.4. That was expected, and same as the December number. So that puts us year over year on a headline basis at 6.4%, which is higher than the 6.2 that had been expected, and 5.6 for the core on a year-over-year basis, higher than forecast as well. But both of those down a tick from the December numbers. So we are seeing a little bit of improvement, not as much as perhaps people would have liked, but basically we are seeing there are some statistical changes that may have affected this. So we'll go through the numbers and see what the actual changes are. The one thing I can tell you, because you asked me, John, was gasoline was up 2.4% in the month of January. And so energy prices there did make a difference. Natural gas prices were up 6.7%. That had been a weaker area, but, with the cold weather, come up a bit.
Mike, you keep breaking this down. I'll just break down the price section. We were positive. We're now slightly negative by not even 1/10% on the S&P 500. Yields were lower on the session, then they flipped positive. So they were down about 2 basis points. We're now up about 2 or 3 on a 2-year to 454 again. 455 was the high of the session yesterday. So we're kind of back to those levels again. Up about 2 or 3 basis points through the front end of the curve into the belly onto the 10-year. Up about a single basis point to 372-ish. These aren't major moves relative to where we have been. But Lisa, the data is something we'll continue to chew over in the coming hours and the coming days, no doubt.
This is significant, especially on the heels. Yes, it was bang in line with the survey. However, the revisions that were upward for the prior month pushed the year-over-year comparison to really not declining all that much. I mean, how much does this really edify what Stephen Stanley was saying? Perhaps we're getting some disinflation, but it is much slower than people previously thought. And I think that stickiness is what you're feeling in the core and the headline number.
TK, your take on this one?
My take is Bloomberg's got really good immediate parsing of this, and a lot of trends just continue off this. I think what we're going to hear is it's another data point. They're going to need more of it. Let me get up to Fed meetings here. I want to be sure I quote this. March 22, so we get another inflation report before that meeting. I'd tandem them together. I'd make a 3-month moving average and annualize that puppy.
The Federal Reserve Chair turned around and said the disinflationary process has started. Mike McKee, does this morning's data support it or contradict it?
It seems to support it because he was basically looking at goods prices versus services prices when he was talking about that. And it does look like we had a decline in goods prices to a year-over-year rate of 1.4%, down from 2.15% in December. So a change there. Service prices continue to go up, 7.16% in December. That was 7.05. So we have some goods disinflation. We don't have services disinflation yet. A couple of notes on what has come in here in terms of changes. Rents at this point up 0.8. That's the same as in December. And owner's equivalent rent down 0.1 to 0.7, but that's still a high number for housing, which is why the Fed wants to take that out and see what's happening with other aspects of housing.
We'll talk to Stephen Stanley about this, and Liz Ann Saunders talking about housing matters, and I'm looking at an annualized basis here, and the trend is what our viewers and listeners feel. Back to October, Mike McKee, 6.9% owner's equivalent rent, 7.1%, 7.5%, and the latest print, unless you want to correct me, is 7.8%. Those are still big numbers, and that's what we're feeling out there.
Yeah, those are still big numbers, but it's the way the CPI is constructed, takes into account rent for the whole year. So it takes a year for that. For new rent prices to get into the components, and we've seen that the most recent numbers, according to other aggregators, are that the rents are coming down.
John, the nowcasting here in the markets is something.
It's something else, isn't it? I'm not going to try and explain this. Yields were down going into the print. Yields were up after the print. They're now down aggressively. They were down by 9 basis points at one point on a 2-year. They're now down about 3 basis points. You can lose that word aggressively. Lisa, things are all over the place off the back of this print.
Okay, 2-year yields are yo-yoing. I mean, this really looks like a kid trying to play with a yo-yo. I don't understand. Stock markets, basically, rally's going to rally. That's all I can say. And that's basically where people are going to take this, because you're seeing inflation that, by some metrics, are hotter than expected.
Is that a job interview for Brad? She's trying to move to Wall Street.
Rally's going to rally.
Rally's going to rally.
Rally's going to rally. That'd work on the sell side. They'd love that.
Well,
They'd
that's momentum. That's the momentum trade broken down for the millennial.
I'm going to run and leave you to it, and you find someone who wants to explain this. At the top of the hour in about 25 minutes, I'll catch up with Mohammed Al-Arian. Looking forward to that conversation.
She's going to say rallies are going to rally.
Mohammed's probably not going to say rallies going to rally. After we've broken down the data with him and talked about what it means for the Federal Reserve, Mike McKee and I will catch up with the Richmond Fed president, Mr. Barkin. So that's going to be the first Fed speaker off the back of this data, Mike.
Yeah, that's going to be fascinating to see. I suspect that given the market reaction, his reaction will be, it could be good, could be bad. It's just like, how do you... what it looks like is this came in as expected. Some people were leaning one way. The first 5 minutes is always a roulette wheel in the markets right after the data come out. So probably not a huge thing. A couple of notes. New cars were up 0.3. Used cars down 1.9%. And that's sort of continues the trend. It was down 2% in the month of December. So still getting some benefit there, although that's likely, they say, to turn around. And we did the services shelter. Apparel prices up 0.8. A bit of a surprise because you would think that the clothing would go on sale right after the holiday period.
What we're going to do here, folks, Mike McKee's going to dive into the data. I can see over here out of my left eye here, he's got columns and columns and rows of David Rosenberg-like data. He's going to dive into that. And we have the privilege of continuing with Stephen Stanley before Kenneth Rogoff of Harvard University. Mr. Stanley is with Santander, their U.S. capital markets shop. Stephen, you've had time to dive into a first look at this interesting data. What's the adult take?
So it was largely as expected, but I would say it could have been worse. We saw a big decline in used car prices again. We saw a big decline in airfares again. Those things are not likely to continue for much longer. Medical care services prices were down 0.7. That's probably, an exaggeration of what we're likely to see in that category. So, and obviously there were upside surprises too, but my point being that some of these volatile categories that had been driving down the readings in late 2022 continued in January, and we still got a 0.4, which again, I think speaks to what we were discussing before, that as long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
This is absolutely critical. There's no other way to put it here, folks. And we see it from an equity strategist like Liz Ann Saunders, an economist like Mr. Stanley. The idea of housing is being overwhelming. How overwhelming is it, Stephen? Give us a percentage of our lives that are based off the set of housing data you have.
Sure. Well, the CPI, I think, maybe exaggerates a little bit, but if you just combine rent and owner's equivalent rent, those two account for a little over 40% of core CPI. So when we talk about, the super core idea, we're taking out a big chunk of the numbers. Now, the weights are a little bit smaller in the PCE deflator, which is the inflation indicator that the Fed most closely focuses on. But yeah, within the CPI, housing is maybe the story.
We're going to talk here with Stephen Stanley of Santander. Michael McKee is digging into the data, and we're thrilled to bring you Kenneth Rogoff of Harvard University with his perspective here in a bit. We're commercial free here to the top of the hour. Lisa?
Yeah, as we watch the yo-yo action in markets, which really builds on what we've seen so far this year. It's like a child's toy, what's going on right now in markets. And I am wondering, Stephen, whether you're looking at the inclination to rally, which is something that we have seen so far this year. How much of a challenge does that present to a Federal Reserve that on the margins is seeing the disinflationary process that is too slow for comfort?
Yeah, well, I think, the markets and the Fed have not quite been on the same page for a while now. The markets have, embraced slower inflation late last year. The markets want a quick Fed pivot later this year. And the Fed has been trying to push back against that to no avail. I thought, Chairman Powell had a nice chance to really kind of push back at the FOMC meeting when he was asked about financial conditions, and he didn't. So I think the Fed has taken the tack of we'll let the data, determine how the markets react, and we think the data are going to play out in a way that will get things closer to where we think they should be.
Yeah.
It's always a dangerous game when the Fed tries to influence asset prices.
It's a dangerous game when they try to influence asset prices, and yet traditionally this was one of their main transmission mechanisms of monetary policy. How much do they get further away from their goal as financial conditions, by most measures, ease substantially to some of the lowest levels going back, some of the most accommodative levels going back to early 2022?
Yeah, and there's no doubt. I mean, it's the minute the markets sniff, that the Fed might not have to go quite as much, financial conditions ease. So in some ways, it kind of it's a self-equilibrating process. But from the Fed's perspective, the concern is that even if you get somewhat weak real economic data, inflation might prove sticky or stubborn.
Yeah.
And that's the scenario that the market really hasn't been willing to contemplate much.
Stephen Stanley, thank you so much with Santander this morning. Diving into the data, Michael McKee here. Is it this time is different, as Rogoff would say?
This time is better. I mean, I can give you a good reason if you want to be optimistic now.
Please.
And we can all go home and forget about the Fed because inflation is licked. The supercore, we have the number now. It comes in at 0.27. So 0.3% gain during the month of January. That compares with a 0.4 gain, 0.37 for the month of December. So take out housing, and as Stephen said, you got 40% of that you're whacking out of the CPI, and in terms of the core, and you've got some progress. So we're still seeing some gains.
Come on, isn't this too cute at a certain point?
Oh,
I mean,
sure.
especially if you take a look at some of the aspects, you strip out everything and you get what you want to get. This is massaging the data. And on one level, I understand. On the other level, you've seen some reinflation in areas like used cars. You've seen reinflation in areas, including, a whole host of different metrics. So how do you sort of parse out and be this nuanced about it?
I think the key is you said you can strip out stuff and get what you want to get. The Fed's not trying to get anything. They're trying to get a measure. They're trying to use it as a measure of what inflation is doing. And because housing is such a big part of CPI, it distorts the rest of the price movements. And so if you want to see what's going on there, you kind of take that out. And it doesn't mean that inflation is gone, but it means there's progress in things other than housing, which is going down. It just hasn't worked its way into the system yet.
Michael McKee, much more on this, and of course joining John Ferro here in a bit. I believe he'll be on radio with us as well. 4.53% in the 2-year yield, an elevated 2-year yield, red and green on the screen now. Lisa will tell me when we jump up or down a substantial amount here
now,
in the next cup of coffee.
It's
this
literally
is a joy on a busy inflation day to have Kenneth Rogoff with us, to say he's professor at Harvard University. His work for the nation at the International Monetary Fund defies a description of this time is different. A seminal book here that is must read, must own, but far more his courageous The Curse of Cash, which was out a number of years ago on this inflation day, on this day where Lael Brainerd will join the White House. There's things to talk about, but we will talk about crypto here in a moment with Professor Rogoff. Ken, thank you so much for joining us this morning.
Hey, great to be here.
There's some people making news on inflation. One of them is a guy named Summers, who I think you've got a nodding acquaintance with at Cambridge. Is the character of this inflation the shock disinflations pre-Eisenhower 47 and through the 50s? Is it like the 60s and the worry pre-Volcker, or is this a different inflation?
Well, I think the Fed clearly is more alert than at an earlier time. On the other hand, I think, as Lisa's been saying and others, inflation's still here. The economy is still strong, and I think they have to decide how to play it. And one thing I think people maybe aren't paying enough attention to is that when inflation comes down, don't be sure interest rates are going to come down as much as people got used to before 2022. I think the next decade we're going to land at a higher real interest rate than we did before. So it's not just the Fed doesn't just have to figure out, how much is inflation. They have to figure out where do we put the interest rate long term so that we don't have inflation.
My book of the summer is Olivier Blanchard's new monograph that's out. That's just absolutely brilliant on something academic, R-G, to keep it simple as well. The heart of Professor Blanchard's thesis is there's other things going on here we're really not observing right now. It's just not as cookie cutter, as simple as all the simple analysis that goes on day to day. What's a thing going on here post-pandemic that changes our financing, particularly as Olivier talks about, changes our debt analysis?
Well, I think there are two things. One is, I think inflation-adjusted interest rates are going to land higher than Olivier does. I think if you look at history, yes, there's a slight downward trend in the inflation-adjusted interest rate, but it's very tiny compared to how much it fell after the financial crisis. And I think there's going to be more mean reversion than perhaps he does, but who knows? I mean, that's a lot of uncertainty. And I'd say a second point is China is not going to be the same in the next decade as they were in the last decade. Yeah, they're rebounding off COVID lockdown, but I think that's also really going to those are two big changes in trends that we're going to see after the pandemic that we didn't have before.
Why then is it important for there to be essentially tighter financial conditions for longer, right? Because higher real interest rates imply it's not just an inflation story.
Well, we had lower financial conditions for longer for a long time because people were scared after the financial crisis. Saving was really high, investment was really low. Now we've entered an era where debt has really gone up quite a bit, private and public, which leads to some adjustment in the interest rate. Probably defense spending is going to go up. Spending on green transition is going to go up. More populist governments from Latin America to the United States to Europe. So I think there are a lot of factors that will lead to more of a normalization.
So people are listening to you and they're thinking to themselves, is that good or bad for stocks? Ultimately, is this good or bad for the markets? Because that's sort of how people have viewed all Fed actions in recent years. Basically, tighter financial conditions have been bad for markets, and yet an effective tightening has allowed markets to rally that much more. Can you see that sort of sustained momentum of financial markets, even in the face of tighter monetary conditions, of higher real rates?
So higher real rates will mean lower asset prices in general. But what's going on right now, of course, is that the economy is stronger than we would have guessed if the numbers were right from the last labor market report. And that was incredible. It was eye-popping. Then the economy is doing pretty well, and that's good news. So if the interest rates are tighter from that, that's obviously good for markets.
If you're just joining us on radio and television, welcome to Bloomberg Surveillance, a key inflation report. Lisa's monitoring. Can I say green on the screen now? I think just here for the last
I don't know.
Second. Futures up 3, and there's some serious gyration going on here before we get to the opening. VIX 19.41, the 2-year yield 4.52%. We're thrilled to have a substantial conversation this morning with Professor Rogoff of Harvard University. Long ago and far away, you exited the IMF, and then Blanchard was there with Stiglitz, and post-GFC, they looked at 4% inflation. What an uproar that ensued. And then I would suggest that Peterson, Adam Posen, has talked about 3% as a new appropriate level. Are we going to get away from an anchored 2% verbiage? Are we going to reset? I got to make some news here. Ken, help me. Are we going to reset this morning higher than a 2% level?
I'm not going to be able to help you, Tom. I think that's extraordinarily unlikely and, frankly, not a good idea. Yes, probably back in the day, they should have set 3% instead of 2%, but they didn't. And, they've really made commitments. If you change it, it means you might change it again. So I think what in fact will happen, I don't think we're going to have a soft landing, by the way. I think we're going to have soft, but not the landing. I think inflation's, they're going to allow to be elevated for longer, but they're going to say it's going to get back to 2%. We're
Yeah.
just taking longer. I think that's going to be the rhetoric.
I want to shift here to China, as you mentioned earlier. And to me, what's so important, Ken, and I mentioned there's this guy named Obstfeld who wrote a textbook a few years ago with a guy named Rogoff. I think it's 9,000 pages long. It's like in the Game of Thrones where they take it off shelf.
It just feels like
it just
9,000
feels like it just feels like that. But Ken, what's so important here is we go from Obstfeld and Rogoff to the work that Lau Brainerd did with David Riker 20 years ago on trade and labor. Sum in your international economics with a challenge Dr. Brainerd is going to have at the White House with this evil thing out there now, China. She's expert on trade and labor multinational dynamics. Where are we heading on that with China?
Well, first, let me say I have the utmost respect for Lael. I actually worked under her at Brookings when I was a visiting scholar in her section. I've known her for a long time. She's terrific. I think trade economists are looking at the data so far and saying, what deglobalization? Everybody's talking about it, but it's not in the data yet. But if you look at the tensions with China, and I have to say, particularly if something goes on in Ukraine, say with Russia really escalating with nuclear neutron bomb or something, and China continuing to trade, we are going to have to be talking about secondary sanctions, which we had done with Iran and North Korea, but we've absolutely not done with Russia. You want to trade with Russia, it's your business, it's fine. And then that really will be something. And a lot of the effects we saw in the labor market could be partly reversed. But short of that, it's modest, the changes that we're likely to see.
The shift from Lael Brainerd from vice chair to the head of the Economic Council for President Biden does highlight also the very political nature of making some of the decisions that you talk about, the sort of Adam Posen take on it, the Kenneth Rogoff take on it, that the Fed will allow inflation to remain higher for longer. How much is that a response to the sort of deglobalization that policy is going to hope for, this admission that you don't want to kill the economy? How political is that decision of allowing inflation to run hot heading into later this year?
Well, I personally have long said I just thought it was the right decision because basically we don't know what's going on. The labor market, has all these distortions that are coming off. The economy has all these distortions that are coming off. And you don't want to, race ahead like you know what you're doing for sure. I wouldn't be surprised if interest rates end up at 6 to bring down inflation. But why do you want to get there right away? Why do you want to rush to that judgment? Maybe they're going to end up much lower. So I think I don't think it's clearly very political at some level because growth is strong, but inflation's high. Which way do we choose? That is a political decision. It affects people differently, but the Fed tries to approach it in a technocratic way.
What he just said there, that rates could get to 6%, but why rush it, right? This is an important point. So do you think that it is appropriate to do 25 basis point increments, or do you think that they should just sort of sit on their hands and wait for a number of months to really get underway since there isn't a rush, in your view?
Honestly speaking, either strategy would be reasonable at this point, but they're kind of committed, I would say, to do 2-quarter point hikes at this point, given the labor market data, given the inflation data. And I don't think it matters a lot one way. It would matter more if suddenly we don't know what they're doing. But I think the real message is that who knew what was going to happen with the labor market report? And so I think there's a lot of uncertainty around, and that means to move slower and cautiously, but you can't predict too far ahead.
Ken, I want to get in and do this without first-order difference equations, or they'll all turn the channel or drive off the road. I remember post-Volcker, and Olivier mentioned this in his book, he and Jeff Sachs wrote an essay in 1981, and boy, were they taken to task that higher rates can be not crucial for worrying about debt sustainability. So many of our listeners and viewers are scared stiff that if we get higher rates, or where we are now, or the 6% you talk of, that we're not going to be able to fund our debt and our deficit. Are they linked, or is it separate? Can we be comfortable with a higher rate regime given the debt of the nation?
Well, first of all, the United States is the global currency, so we have a lot of debt capacity. The question is how much it costs us. The real outcome, if we have too much debt, is that we'll get more inflation at some point. That's what just happened. We just had an effective partial default on debt. Inflation was much higher than anyone was expecting, and that put money in the government's pockets. That option's there. It's a soft partial default.
Right.
That's what we're talking. We're not talking about not paying the bills unless some crazy people in Congress decide to do that.
I had no time for crypto. There's a more important question. I believe there's a vacancy at the Fed. Would you consider being vice chairman of the Federal Reserve System?
I don't think I'm likely to be a candidate for that, but thank you for asking.
It's good.
Because it's his to offer the job, so it's good that he checked
I'm
in.
just trying to make news.
Yeah,
We're like
exactly.
0 for 7 with Rogoff today.
I disagree.
6% inflation was very impressive.
No, 6%.
rates.
There was a lot, though. This is a really important point because it was sort of edifying this Adam Posen view, where why is there a push to get back to 2% inflation? Are we going to get that kind of view? Even if you want to see disinflation, then at what point is it enough disinflation to be okay? These are some of the discussions at a time when it is a political decision and the economy is still strong.
I'm going to defend the land of Rogoff, and that the common feature, even if they disagree, so he mentioned at the beginning he disagrees with Professor Blanchard, who's more quiescent about we can come back and the real rate can stay down and all that. But the answer is these people have a hard-earned humility by knowing the history of inflation fear, as in Reinhardt and Rogoff. There's a humility here, Lisa, that I don't hear in the noise of Twitter and the noise of the rest of it.
Or the noise of markets where they're just flip-flopping back and forth trying to get a sense of what to do. And this is sort of the issue, right? We don't know where we're coming from and we don't know where we're going in terms of what inflationary shock we just experienced and what kind of labor market disruption that we're currently amidst.
Well, we're going to have to see here 4.53% of the 2-year yield again on the 6-month T-bill, hearkening towards where Professor Rogoff is talking. A 5% print on the 6-month T-bill is something new, certainly in the next 6 months. It has been an extraordinary show. Thank you to our team here for making this hour so interesting. Ken, thank you so much for the generous time this morning. We will drive forward the conversation in the next hour. Thomas Barkin of the Richmond Fed. There's a culture there, a fabric that is so different. Barkin of Richmond with Michael McKee and John Ferro. Stay with us. This is Bloomberg. Good morning.